Thank you very much. This is Andre Goldsmith. Good morning, everyone. As the designated federal officer for the Global Markets Advisory Committee, it's my pleasure to call this meeting to order. I'd like to welcome everyone to today's meeting. In light of the global response to COVID-19, we're holding today's meeting as a virtual meeting to protect the safety of agency personnel, GMAC members, guest panelists, and the public. To ensure that today's meeting goes as smoothly as possible, there are a few logistical items that I would like to mention. Because this is a virtual meeting, it's also being broadcast in a live stream on the internet, so please be sure to identify yourself before speaking. Also, please signal when you have completed your comments so that we can continue with the next speaker or question. Please ensure that your phone is unmuted before you start to speak, that you speak clearly into your phone, and that you remute your line when you are done speaking. For GMAC members and commissioners, if you would like to be recognized during the discussion, please use the WebEx chat icon at the bottom of the screen, select the All Panelists option within the drop-down menu, indicate that you have a comment or question, and press Enter. If any meeting participant needs assistance during the call, please dial *0 to connect to the conference operator or message me directly within the WebEx chat. Finally, please keep your telephone line muted when you're not speaking. If you do not mute your line, the conference operator may need to mute it for you. I'd now like to turn things over to the GMAC sponsor, Commissioner Dawn Stump, for her opening remarks.
Good morning. Thanks, Andre, and welcome everyone to today's meeting of the CFTC's Global Markets Advisory Committee. I want to begin by thanking Acting Chairman Benham for attending today's meeting, and I also want to recognize that due to the global nature of this committee, there are many participants in less than ideal local time zones, and I am extremely grateful for their willingness to do so. I would especially like to thank all of today's esteemed presenters for being here and for taking the time out of your busy days to contribute to our discussion. Additionally, I would like to thank Chair Angie Karna for her leadership of the GMAC and Andre Goldsmith, the GMAC's designated federal officer, not only for her tremendous efforts in organizing today's meeting, but her assistance with the GMAC over the past 3 years. Today marks Andre's last GMAC meeting, as she will soon depart the CFTC. And I, for one, am very sad to see her go, but I know she will do amazing things in her next chapter. I know I speak for every member of the committee in expressing gratitude for Andre's remarkable ability to ensure we always enjoy a complete, diverse, and global membership ready to engage in a variety of topics. Her job is not an easy one, and her shoes will be hard to fill. Thank you, Andre, very much for your help over the past 3 years with the GMAC. Turning to today's meeting, I wanted to just go over briefly what we will be covering. We have 3 panels, the first 2 of which will focus on the U.S. Treasury market. Because of the interconnectedness between the Treasury market and the derivatives market, the health and the efficiency of an efficient function of the Treasury market is vitally important to the integrity, resilience, and vibrancy of the markets we oversee here at the CFTC. Because of these interconnections, I thought it important to focus much of our discussion today on the recent stresses in the U.S. Treasury market and the various proposals and recommendations that have been made to mitigate such in the future. In that regard, Panel 1 will feature 2 presentations. First, we will hear from Sam Schulhofer-Wohl, Senior Vice President and Director of Financial Policy and Outreach at the Federal Reserve Bank of Chicago, who will discuss some of the recent events that have affected the Treasury market. Next, we will hear from Michael Pedroni, Executive Vice President and Managing Director, Head of Global Research and Markets, and Jennifer Hahn, Chief Counsel and Head of Regulatory Affairs, both of the Managed Funds Association. We are grateful they are willing to share the experience of the MFA membership as it relates to the recent events in the Treasury market, as well as their view on some of the reforms being discussed. The second panel will feature 3 presentations that will dive deeper into one of the most discussed proposals for reforming the U.S. Treasury market, increased central clearing. The panel will start with Professor Darrell Duffy, Adams Distinguished Professor of Management and Professor of Finance at the Graduate School of Business at Stanford University. The next presenter, Mr. Graham Harper, will discuss central clearing of treasuries from the perspective of principal trading firms. Mr. Harper is a member of the Executive Committee of FIA's Principal Traders Group and Head of Public Policy and Market Structure at DRW Trading Group. Then we will hear from Laura Semple, General Manager at the Fixed Income Clearing Corporation, who will discuss various clearing models and how they may be able to support increased central clearing of Treasury transactions. For the third panel, we will pivot to a discussion of recent developments in the CFTC's continued implementation of the Dodd-Frank Act. Our presenters for panel 3 are Tara Cruz, Global Head of Infrastructure, Data, and Non-Cleared Margin at ISDA, Kyle Brandon, Managing Director, Head of Derivatives Policy at SIFMA, and Colin Moy, Partner at Clary Gottlieb, Steen and Hamilton. Together, our presenters will discuss the recent implementation efforts of various Dodd-Frank rulemakings, including swap data reporting, margin requirements for non-cleared swaps, and swap dealer capital substituted compliance. Our panelists will focus on the implementation challenges faced by market participants, as well as some of the recommendations that have been made to alleviate these challenges. I'm very much looking forward to this morning's presentations, and again, I wish to thank all the members of the committee, as well as the panelists, for being here today and furthering these important conversations. And our GMAC members will no doubt have a robust discussion and an engaging dialogue. So thanks to everyone for being here, and I look forward to the discussion. Back to you, Andre.
Thank you, Commissioner Stump. Chairman Benham?
Andre, thanks, and good morning, and potentially good afternoon and good evening to some who are listening across the globe. It's wonderful to be here. First, thanks to Commissioner Stump, of course, as sponsor of the GMAC, for her leadership and really the vision for an excellent dialogue today. And as we've had in the past, this is going to be a wonderful discussion. A special thanks to Andre Goldsmith, and best of luck to you, Andre, in your next chapter, as Commissioner Stump said, and of course, thanks to Angie Karna as well for her leadership as chair of the GMAC. Today's discussion is as pertinent as they get, and as usual for the GMAC, I'm very interested to hear about the Treasury market discussion, not only because of what we experienced in the sort of peak March-April 2020 period, but certainly what we've had in terms of experiences in the Treasury market and the relationship between cash and derivatives, really in the past decade and even more. So there's going to be a lot to learn in the conversation about clearing, again, as relevant as they get, as a lot of those discussions are very active within policy groups. So a great panel of speakers that will have different points of view and certainly help inform the CFTC as we play our part in that larger discussion and evolution of the Treasury markets. And then quickly, just commenting on the last panel, so much has happened at the Commission in the past few years, and certainly if we look back to 2010, implementation of Dodd-Frank has been a challenge at part, but a success in many parts as well. But it's never too late, but also we should always focus on, in my view, consistently reviewing rules and policies so that the markets are functioning the best that they can, and that there's efficient, transparent markets, but also ones that are serving customers and end users. So I think this is going to be a timely discussion as we're moving forward with a new agenda in the few years to come, and certainly look forward to working with Commissioner Stump and the GMAC with any findings or conclusions that this committee or this particular group may have. So thanks again to all who are participating and listening, and thanks to the panelists for their willingness to share their views and thoughts. And again, thanks to Commissioner Stump for her leadership on this conversation today. Thank you.
Thank you, Acting Chairman. Thanks again to the commissioners for taking part in this meeting of the GMAC and for sharing your remarks with the committee. Before we begin with our presentation today, I'd like to do a quick roll call of the GMAC members on the phone so that we have your attendance on the record. After I say your name and firm, please indicate that you are present. Chris Allen, Standard Chartered.
Yes, I'm here. Hi.
Thank you. Ted Backer, Morgan Stanley. Ashley Bellich, RBC Capital Markets.
Yes, present.
Thank you. Sean Bernardo, TP ICAP Staff. Darcy Bradbury, DE Shaw & Co.
Present.
Thank you. Maria Chiodi, Credit Suisse Securities. Joe Suzuki, Better Markets. Jim Colby, Coalition for Derivatives End Users. Gary Corcoran, R.J. O'Brien and Associates.
Present.
Thank you. Thank you. Danilo Coutinho, CME Clearing.
Hi, I'm present.
Good morning. David Goon, Intercontinental Exchange.
Present.
Thank you. Paul Hamill, Citadel Securities. Amy Hong, Goldman Sachs.
Present.
Thank you. John Horkin, LCH Group.
Present.
Thank you. Adam Kanzler, IHS Market.
Good morning, President.
Good morning. Thank you. Angie Karna, Nomura Securities International.
I'm present, Andre. Thank you.
Thank you. Bob Klein, Citigroup Global Markets.
I'm present. Thank you.
Thank you. Agnes Ko, Singapore Exchange.
Present.
Thank you, Agnes. Janet Kong, BP Americas.
Present.
Thank you. Ben McDonald, Bloomberg.
Present.
Thank you. Eric Mueller, Eurex Clearing.
Good morning, President.
Good morning. Thank you. Joe Nicosia, Louis Dreyfus Company. Murray Posnanter, DTCC. Tom Sexton, NFA.
Good morning, President.
Good morning. Thank you. Maggie Sklar, Federal Reserve Bank of Chicago. Jessica Soul, HC Technologies. Shane Twiggs, Cargill Risk Management.
Good morning, I'm present.
Good morning. Superna Vedbrat, BlackRock.
Present.
Thank you. And Masa Yamada, JP Morgan.
Good morning, I'm present.
Good morning. Thank you. If I did not acknowledge your presence on the call, please email me or message me directly in the WebEx chat to confirm your attendance for the record. With that, I'd like to turn the program over to Angie Karna, Chair of the GMAC, for an introduction of our presenters for Panel 1. Go ahead, Angie.
Thank you, Andre. Just a few logistical reminders. Please keep your phones on mute while you are not speaking. Following the presentations, if a GMAC member or commissioner would like to be recognized to speak, please use the WebEx chat icon at the bottom of the screen. Then select the All Panelists option within the drop-down menu, indicate that you have a question, and press Enter. Please identify yourself and your firm prior to speaking and indicate when you are finished speaking. Our first panel will focus on the recent stresses in the Treasury market and the reform proposals and recommendations that have been made to mitigate against future stresses. Our first presenter is Sam Schulhofer-Wohl, Senior Vice President and Director of Financial Policy and Outreach at the Federal Reserve Bank of Chicago. Please go ahead.
Thank you, Chair Karna, and thank you to Commissioner Stump and Ms. Goldsmith for the kind invitation to speak with you today. As you noted, my name is Sam Schulhofer-Wohl, and I am Senior Vice President and Director of Financial Policy and Outreach at the Federal Reserve Bank of Chicago. I oversee our research and policy analysis on financial markets, especially derivatives, as well as our community development and public affairs programs. I've been asked to speak about recent dislocations in the Treasury market and the path forward for improving market resilience. As always, the views I express are mine, and not necessarily those of the Chicago Fed or the Federal Reserve System. Also, because there is a Federal Open Market Committee meeting next week, our communications blackout rules limit the topics I can discuss. I will not be commenting on current or prospective economic and financial conditions or current or prospective uses of the Federal Reserve's policies and tools. No inference should be drawn from my silence on these matters. I also will not be able to answer questions today, but I very much value dialogue and would welcome the opportunity to engage with you further outside the blackout period. With those disclaimers out of the way, let me turn to Treasury market resilience. The Treasury market serves many vital purposes. It is a source of financing for the government. It provides safe and liquid assets for savers and investors. It establishes a risk-free yield curve, and more. Both the financial system and the American people benefit from the market's considerable strength. It is, as this audience knows, the deepest and most liquid market in the world. Nevertheless, there have been some significant dislocations in recent years, and we can try to learn from these events to make the market more robust. I'll discuss two events: the March 2020 pandemic stresses and the September 2019 repo market pressures. Each event was unique, but there are some common threads, and I want to highlight one in particular that might shed some light on resilience. That common thread is the behavior of supply and demand for liquidity. In March 2020, as the COVID-19 pandemic spread, people around the world faced an extraordinary threat to their lives, health, and livelihoods. Actions taken to control the spread of the virus led to extreme disruptions of economic activity. Financial markets reacted with severe volatility. After an initial period of typical flight to safety inflows into Treasury securities, these highly uncertain circumstances caused broad-based and rapid sales of Treasuries, especially seasoned securities with longer maturities. Overall, there appear to have been three distinct sources of these sales. First, in the face of economic and financial stress, many market participants sold their most liquid non-cash assets, frequently Treasury securities, to obtain cash and cash-like assets such as Treasury bills. These sellers included mutual funds bidding redemptions, foreign central banks considering currency interventions, and traders covering margin calls, among others. Second, some market participants were motivated to unwind positions when the volatile environment changed the economics of certain trades. For example, Treasury cash futures basis positions became riskier and more costly amid uncertainty about funding availability, the risk of large variation margin calls, and higher initial margin requirements intended to protect central counterparties against the increased market risks. Third, precautionary concerns amplified the initial rush of sales. For example, as it became clear that the sales were challenging market functioning, some Treasury holders appeared to sell not because they needed cash immediately, but in order to guard against the risk that market functioning would deteriorate further. Someone who wants to sell Treasuries needs to find a buyer, typically through an intermediary who provides market liquidity. So the broad-based desire to sell Treasuries was, effectively, a dramatic increase in the demand for intermediation. On the whole, intermediaries, such as dealers and principal trading firms, greatly increased their activity to meet this demand, as reflected in the large increases in trading volumes in the Treasury market in March 2020. However, there were limits to intermediaries' capacity. These limits appear to have reflected, in large part, the interaction of the extreme market volatility and uncertainty with intermediaries' risk appetites and business strategies, and, in some cases, the influence of regulations on these. In this context, bid-ask spreads and other measures of liquidity, such as the price impact of trades, reached the worst levels since the global financial crisis. The market stress resolved only after the Federal Reserve purchased Treasury securities on an unprecedented scale, and following additional forceful actions by the Federal Reserve, Treasury Department, and Congress to support smooth market functioning and to aid the economy. You can think of measures like the bid-ask spread as indicators of the price of market liquidity. If the bid-ask spread is wider, intermediaries can make more money by taking both sides of the market, and it costs end users more to get in and out of positions. So to sum up, in March 2020 in the Treasury market, the demand for intermediation went up, the supply of intermediation went up, and the price of intermediation went way up. As an economist, I think of the rising price as providing powerful incentives. The bid-ask spreads and other measures show that there was a lot of money to be made by intermediating, and a big cost to trading as an end user. And yet, despite these powerful incentives, the supply and demand for market liquidity did not respond enough to avoid market stress. Perhaps that simply reminds us just how large the pandemic shock was. Now let's turn to September 2019. On the 16th of that month, a quarterly tax payment date and the settlement of a Treasury auction drained funds from the financial system, even as the auction settlement increased some institutions' need for funds. Earlier in the month, repo rates had been trading a bit below 2.25%, but on the morning of the 17th, rates spiked as high as 9% on some trades, and the secured overnight financing rate, or SOFR, settled at 5.25%, up 282 basis points from the day before. Rate pressure spilled over to other money markets, such as federal funds, and subsided only after the Federal Reserve carried out large-scale repo operations. A repo interest rate like SOFR is the price of funding liquidity, the ability to use an asset as collateral. And if we could turn to the next slide, please, I'd like to show you a familiar but still remarkable graph of this price. This graph shows SOFR as well as the volume of transactions used to compute it. Basically, all overnight general collateral tri-party and centrally cleared bilateral Treasury repos. You can see the spike in rates on September 17th. And if you look really closely at the volumes on the 17th, you can see that nothing much happened. The supply and demand for funding liquidity were not particularly responsive to the price of funding liquidity. And so the price, the interest rate, had to rise enormously for the market to clear. Now, these dynamics are pretty different from what we saw in March 2020. The shock in September 2019 wasn't nearly so large. Rather, a major factor appears to have been that even though the overnight repo market reprices every day, it was difficult for participants to significantly change their activities from one day to the next. Borrowers needed to fund their assets and couldn't quickly exit positions at a reasonable price. At least in the short run, it made sense to pay very high repo rates to get funding. Lenders, meanwhile, often relied on relationships with particular borrowers, and trading desks operated within limits based on an institution's overall strategy for deploying its balance sheet. So it was difficult to rapidly ramp up lending when rates were spiking. But even though the dynamics in September 2019 and March 2020 are different, there still is the common thread that at times, supply and demand for liquidity haven't adjusted enough to keep the price of liquidity from soaring. We can think about some potential improvements in light of that pattern. As I mentioned, I cannot speak today about current and prospective Federal Reserve policies and tools. I will instead note three other areas that researchers, market participants, or agencies have discussed publicly. All of these, in my view, may affect the responsiveness of liquidity supply and demand in the Treasury market. First, there have been calls to improve the collection and increase the public dissemination of market data. Treasury futures, as an exchange-traded and fully centrally cleared market, are subject to extensive data collection and reporting, but there are gaps in data for the cash and repo markets. For example, in the repo market, we have extensive data on the tri-party and cleared bilateral segments, but the official sector has not collected systematic data on uncleared bilateral repo transactions since a pilot project in 2015. Improvements in data collection and transparency could make the market more resilient and elastic in a couple of ways. For the official sector, more complete and timely data may enable more nimble responses when stress emerges, as well as allow for better design of policies ex ante. For the private sector, appropriate data transparency may remove uncertainty and support more responsive trading, though the potential for transparency to interfere with liquidity provision must also be considered. Second, there have been calls to consider expansion of central clearing in the Treasury market. Treasury futures are centrally cleared, but not all repos and cash transactions are. As long experience in cleared markets has demonstrated, and as research by my colleagues in the Chicago Fed's Financial Markets Group has found, central clearing in general has two major benefits: improved risk management and multilateral netting. Both of these, again speaking generally, have the potential to support more responsive trading dynamics by making intermediation safer and, in some circumstances, less balance sheet intensive. However, much depends on the institutional details of a particular market, and the precise effects of broader clearing in the Treasury cash and repo markets merit careful study. Moreover, central clearing concentrates risk at the central counterparty, so continued strong risk management, regulation, and supervision would be crucial. I'm looking forward to today's second panel, which I understand will delve into central clearing of treasuries in more detail. Finally, there have been suggestions to reconsider how Treasury trading venues are regulated. For example, the Securities and Exchange Commission has proposed extending regulations ATS and SCI to alternative trading systems for government securities. These regulations provide investor protections and safeguards for the reliability of electronic and automated systems in other markets. Extending this oversight to Treasury alternative trading systems could help to support access to and reliability of these heavily used trading venues. There are, of course, many other possibilities for enhancing the resilience of the Treasury market. Additionally, while I've highlighted the role of supply and demand for liquidity in some recent events, this is a large and complicated market with many drivers. The lens I've offered is certainly not the only one that could be used to consider how the market might be strengthened. But I hope this perspective is helpful to you, and I look forward to further discussion. Thank you.
Thank you, Mr. Schulhofer-Wall. The next presenters are Michael Pedroni, Executive Vice President and Managing Director, Head of Global Research and Markets, and Jennifer Hahn, Chief Counsel and Head of Regulatory Affairs, both from the Managed Funds Association. Please go ahead.
Thank you very much. It's Michael Pedroni. I want to thank Chair Benham, Commissioner Stump, and the entire GMAC, as well as the GMAC Chair, Angie Kama, and Andre Goldsmith as well, for inviting the MFA to today's session. We want to present our research and latest thinking on Treasury markets, what happened during the COVID shock of March 2020, and what are the reforms we believe are needed to modernize the Treasury markets. I'll start by providing an analysis of the Treasury market with a focus on the unique features that we believe prompted the unprecedented movements, or at least contributed to them, that began in particular on March 9th, 2020, when Treasury prices, that was the date when Treasury prices began to fall in tandem with the equity markets. My colleague Jennifer Hahn will then build on this to share our perspectives on what can be improved to enhance liquidity and functioning of the Treasury markets, even in times of shock. It goes without saying, just as the previous presenter was indicating, that we all need the Treasury markets to continue to function as effectively as possible. Andre, if you don't mind flipping to slide number 2. There are 4 attributes of the Treasury markets in recent events, and then one key observation that grows out of that we think should inform any policy reforms going forward. First, Treasuries are not a uniform market, and each type of Treasury trades differently due to the market structure and practice. Second, the lesson that many market participants seem to have learned from the global financial crisis of 2008 was to lock in dollar liquidity. And the same thing happened in March 2020 as particularly non-U.S. market participants engaged in a dash for dollars. Third, Treasury markets, and especially secondary markets, rely on more market participants than before the global financial crisis. Fourth, repo is far too reliant on bilateral relationships. And then fifth, because of these attributes, we believe that expanded clearing options, including for repo, are part of the answer to modernizing Treasury markets. And Andre, if you could flip to slide 3. Let's start then with that point, that Treasuries are not a uniform market. If you think of the markets for the on-the-run issues, they're very liquid, mostly automated, and highly efficient. But on-the-runs account for just about 3% of total issuance outstanding, even though in normal times they represent 75% of the daily volume traded. So that's on the runs. Off the run issues represent 97% of outstanding issuance, but are far less liquid and are often held as a store of value by long-term buy and hold investors, including foreign central banks. They're traded by various means, including traditional voice brokering and electronic RFQs. Third, we have cheapest to deliver issues. For example, those that are most economical to use for delivering into the active CME futures contracts, and those trade with a liquidity premium. And then fourth, of course, futures are a derivative contracting. I go through this importantly because each of these 4 buckets performed differently in response to the COVID shock. So let's take a look at that in slide 4. Okay, so this shows on-the-run versus off-the-run transaction volumes. The on-the-run asset is strikingly different from the off-the-run asset. As you can see in this chart, the average number of times that the entire outstanding amount of the on-the-run issues is transacted in a week is exponentially more than all of the off-the-runs. This is trace data, incidentally. So looking at the two-year note, the size of the recent issue of the two-year note was $66 billion. That figure is not represented on this chart, but what we want to point out is that over the course of the week, about $128 billion of this two-year note was transacted, so roughly 200%, 195%, equivalent to twice the amount of the outstanding. If you look at the 10-year note, it's even more heavily traded. The 628% there represents $440 billion transacted weekly as compared to the outstanding $70 billion amount of the issue. And then if you look at the second bars next to each of the tall bars, those are the off-the-runs. And as you can see, they barely transact. So very, very different liquidity features between these two markets. Now, if you turn to slide 5, please. One of the attributes I mentioned at the top is that there are multiple sellers in the Treasury markets, multiple participants. And so let's turn to the dash for dollars in March, and let's examine who those sellers are. We know from the macro data that a net $635 billion in Treasuries were sold in March of 2020. The Federal Reserve, in its November 2020 financial stability report, tells us that about $400 billion was sold by non-U.S. accounts amid this dash for dollars, including about $216 billion by central banks, foreign central banks. Recall that in addition to the COVID shock, oil exporting countries were also experiencing a crash in the price of oil, even briefly below zero. So consistent with that, we can see in the Treasury International Capital data for March 2020 that Saudi Arabia was the largest net seller and a significant component of that foreign official accounts slice of 34%. These details are important to note because central banks are usually buyers and holders of off-the-run treasuries. They warehouse these treasuries as a store of value, but suddenly in March, they began selling these warehoused off-the-runs en masse in order to try and raise dollar liquidity. And this dash for cash through traditional relationships between off-the-runs and other off-the-runs sharply out of balance. So in March 2020, just as bank dealers were migrating their trading operations to their homes, a wave of largely voice-traded paper, remember these are deeply off-the-run issues, was flooding into the markets from central banks, private foreign accounts, and others. And given that desks were fearful,
Mr. Schulhofer-Wall, are you on?
Yes. I believe Mr. Pedroni is speaking.
Oh, sorry. Mr. Pedroni, are you on? Ms. Hahn, are you on?
Yes, I am on. I'm just checking on my colleague to see what happened to his line.
Hi.
And I just joined him back in.
Okay, great. Mr. Pedroni?
Yes, thank you. Thanks so much for that. I don't know what happened there other than that the phone line just suddenly dropped. So I think the last thing that I was talking about was the fact that bank desks were moving off-site just as a lot of voice brokered paper was hitting the markets, and that this caused significant disarray in the market for off-the-run issues. So with that, if we can move to slide 6 then. So I want to focus a little bit more on these deeply off-the-run Treasury issues and how they experienced that March 9th through, the most acute period was March 9th through March 13th. March 13th was significant because that was the date when the Fed began purchasing not only a basket of treasuries, but importantly, began to purchase cheapest to deliver issues. And I'll talk a bit more about why that became so important. So this is the kind of microscopic week that we look at to understand the features and the price data. So what this slide shows then is the disarray that I was just describing. We believe that this foreign central bank selling was a major factor in the turmoil. The yield spreads on the first through seventh off-the-run issues against the on-the-run 10-year note, which is what's depicted here, suddenly became sharply misaligned, including against each other. So normally, as you can see in the lead up to March 9th, this relationship is highly predictable, and it's determined by liquidity and remaining maturity of the issues. Now, as you can see, by March 9th, these normally predictable relationships were completely out of whack. For example, I'd like to draw your eye to the behavior of the fifth off-the-run issue, which is depicted, I believe, in green. Please bear with me. I'm slightly colorblind, but I believe that's green. And so in the pre-COVID shock period, it was the third most valuable of the issues that's depicted here because of its lower yield to maturity, principally. Then, starting around March 6th, it vaults up to being the least valuable of all these issues, a remarkable move in spread terms. If you look at it, it's a 10 basis point shift relative, a 10 basis point relative shift to the on-the-run issue, the on-the-run 10-year note, at a time when the 10-year yield was only 0.80%. So truly an unprecedented move in that relationship. This was a market that was extremely difficult to price, sending waves of turmoil through the broader financial markets. And so if you can flip to slide 7, please. Okay, so, the early narrative, and we continue to hear echoes of this, including, in the presentation earlier today, was that hedge fund basis traders were engaged in fire sales of treasuries. But the evidence of this is actually very weak. In fact, the price data in this acute period from March 9th to March 13th shows a very intriguing indication that hedge fund basis traders may have relatively supported the market. So just to level set, and I know this is a highly sophisticated group, but just to level set, a basis trader sells a futures contract and hedges that short futures position with the purchase of cash treasuries. Buying the treasury is obviously a cost, and naturally any investor will want to do that in the least expensive way. Hence, they purchase the cheapest to deliver bond that is eligible for delivery into the CME futures contract. So when treasury markets went into disarray, the fascinating thing here to look at is, and that we have not yet seen consistently explained, is that the cheapest to deliver outperformed. It outperformed the rest of the market by a significant basis, by significant margin. So this outperformance is not consistent with the narrative that basis trading hedge funds were engaged in forced sales, because they would have been selling the cheapest to deliver if they had been doing that. So I can also report that we were, as MFA, in constant contact with our members, risk managers, and funding desks during that March 2020 period, and particularly that week. And we did not pick up any anecdotal information from our members to suggest that they or their peers were, unwinding or engaging in a disproportionate selling of their basis trading positions. And in fact, in a couple of narrow cases, we understood that there was liquidity potentially being provided to the market, or consideration of raising new funds to provide liquidity to that market. Now, again, March 13th is a significant date. We've spent a lot of time looking very granularly at this because there was some indication that perhaps the reason that the cheapest to deliver was outperforming was because the Fed began to purchase cheapest to delivers. Normally, it does not buy cheapest to deliver securities in its open market operations. It did start doing so on March 13th, and so I think that can help to explain the outperformance of the cheapest to deliver after March 13th, starting on March 13th and thereafter. But in that period from March 9th to March 13th, it seems that one of the supporters of the cheapest to deliver, one of those giving demand support to it, would have been the hedge fund community. Okay, so if we can move to slide 8, please. So, now turning to some of the structural points about multiple participants in the market. Treasury markets have outgrown dealer capacity. This is data from Daryl Duffy's paper. I know Daryl will be on the second panel. Part of the reason that Treasury markets rely on a multitude of market participants is that banks' relative capacity to intermediate has declined. This chart here depicts the ratio between bank balance sheets and treasuries in the market, and it clearly shows a drop-off after 2008. If you can move to slide 9, please. So as we said in the beginning, Treasury markets do rely on a multitude of market participants. And in fact, now the single biggest participant grouping in both cash and futures markets are the principal trading firms, with banks second and hedge funds a distant third. These data are from 2014 from the joint SEC, CFTC, Fed Treasury report, but if anything, Treasury market participation has continued to evolve since then. I would point out that hedge funds are not an unimportant player, but a relatively small player in the market. If you can move to slide 10. Okay, so banks do remain the most important source of financing for Treasury positions, and collateralized repo is certainly central to this function. And so here on this slide, we want to point out that in mid-March, repo pricing became much more tiered. This slide shows the dramatic increase in the dispersion of repo pricing during mid-March. So the largest market participants, including MFA members, continued to have good access to repo. But some other market participants clearly must have seen the cost of their financing elevate, as you can see from this is a blowout of 14 times. So the width of the difference between the lowest and the highest repo rate blew out by about 14 times relative to the average. Slide 11, please. Cash balances of basis trading hedge funds is something that we like to point out is stabilizing. Hedge funds that trade the basis know that financing can become scarce, as seen on the prior slide. And as a result, they tend to maintain high cash balances as a prudent measure. On average, relative value strategy hedge funds hold about 25% of their investments in cash as a precaution. Now, if you look at 2020 Q1, you can see sort of 43% for macro and 26% for relative value. These are the strategies that would have been most likely to be participating in the cash treasury futures basis trade. And, if you look at that, if hedge funds had engaged in massive deleveraging in March of 2020, what we would have seen here were big changes in the cash balances. In fact, you see a small tick up in the cash balances of 3 percentage points in each case. Seems relatively consistent and proportionate with kind of a prudent building up of cash balances. And so this leads to then my final point on slide 12, which is that Treasury markets on both the cash and the repo side, we believe do not yet benefit from enough central clearing choices. Repo financing is really the lubrication that allows the gears of the market to turn and to function. And therefore, we feel we should examine potential improvements to it. I would draw your attention to the donut graph on the left, which depicts that 2/3 of repo arrangements are still uncleared. And then on the right-hand side, you can see that on the cash market side, only 13% of the interdealer Treasury secondary market is centrally cleared, and that's far less than in the derivatives markets. Central clearing options, and I think Sam said this very well, facilitate netting and compression, which in turn should improve margin efficiency. So more options for central clearing, as my colleague Jen Hahn will tell you now, would really help to modernize Treasury markets and bring them in line with some other parallel markets. And so with that, Jen, I'd like to pass it over to you.
Great. And if we could turn to the next slide, please. Great, thank you. So in working with Michael's Global Markets and Research Group, our policy committee looked at the data, and we've really thought through some of the potential changes and recommendations that could be made. So again, just from the experience of March 2020, also previous events, 2014 flash rally, just taking into consideration that the Treasury markets have quadrupled in the last 15 years, and again, they're expected to continue growing. So we really think it is important to modernize the market architecture this way to enhance resiliency as well as just to preserve the central role of these markets. So our first recommendation is to expand central clearing solutions. So also we're very eager to hear from the second panel, but here we think that regulators should work together toward expanding the development of voluntary central clearing in the dealer-to-customer segment of the Treasury market, both for secondary cash market transactions and bilateral U.S. Treasury repos. We think that this will greatly enhance market resiliency, lead to greater market transparency, greater market liquidity, reduce credit and operational risk. Also, it will benefit investors by allowing them to net offsetting transactions and have just decreased solvency risk from their counterparties. Our second recommendation is to enhance regulatory data collection. We think that the regulators should work together to enhance the collection to improve the quality of the Treasury data reported through TRACE. So in 2017, FINRA began receiving TRACE Treasury data, and this has proven to be a critical resource for regulators in helping analyze and understand the trading and events in Treasury markets, particularly the most acute stages here of COVID-19, the COVID-19-induced market crisis. Nevertheless, regulators have consistently asked for enhancements to this data, which MFA very much supports. So first, we think that FINRA should shorten the trade reporting time frame for Treasuries. Second, we think FINRA should add a clearing arrangement indicator to trace transaction reports, among a number of other enhancements to provide more granular data. And then finally, we think that banking regulators should require that all bank entities that are not FINRA member firms to report Treasury market activity to TRACE. This enhanced reporting will really improve the reliability of data for regulatory purposes and just allow regulators to have a better understanding of trading and market events. Our third recommendation is to introduce public dissemination of post-trade transaction data. So here, we recommend that FINRA work with other policymakers, regulators to gradually introduce post-trade price dissemination of anonymized data on U.S. Treasury secondary market transactions through TRACE. So, studies have shown that public price reporting, with appropriate exceptions, has really improved market functioning. And I think that for the CFTC, we have the experience of, for example, the SEF market. So we recommend that regulators consider expanding the dissemination of Treasuries post-trade data through TRACE to be consistent with the transparency available for other markets, also such as the corporate bond transactions. Again, regulators should take a phased-in approach, calibrate trade size disclosures and dissemination delays by market segment to protect the anonymity of trading counterparties and to maximize market efficiency and overall market liquidity. So with the introduction of anything, again, a steady and calibrated approach, we think is best. Our last recommendation is to rationalize trading venue oversight. We recently, earlier this year, recommended to the SEC that they extend regulation ATS to alternative trading systems that trade government securities or repo and reverse repo agreements on government securities. So with seeing the growth of electronic trading and electronic trading systems, we think it's really important for investors that regulators ensure the effective regulation of critical market infrastructure and trading venues. Also, we want to ensure the robust disclosure and transparency of information to investors about the operations of these infrastructures and venues. Finally, we recommend that the SEC examine other electronic trading venues. So, for example, multilateral RFQ venues that operate in the government securities markets, and just consider how similarly situated entities might be treated in a more similar manner to improve the efficiency and resiliency of trading in government securities. So that takes us through our slide presentation, and we'll turn back over to Chair Benham, Commissioner Stomp, Andre, GMAC Committee.
Thank you, Mr. Padrone and Ms. Hahn. The floor is now open for questions and comments on all of the presentations of our first panel. And as a reminder to GMAC participants, if you could please indicate in using the chat function if you'd like to make a comment or raise a question.
This is Suparna from, BlackRock. Perhaps I could start, if that's okay.
Sure. Go ahead, Ms. Bedbrett.
I have, actually a four-part question. One, we are in favor of central clearing, and I think over the last decade, seeing the success that we've had with CDS and interest rate swaps talks to how it helps with the overall resiliency of the market. That being said, as we include more and more products, we would highly recommend that, the suggestions that have been made in order to continue to enhance, the overall framework for the clearinghouses, something that, we should consider putting in place over the next, several months. The other thing, the second point I want to make is, from a collateral standpoint, as we've moved products into the central clearing framework, the demand for high-quality collateral obviously has also increased. So, what I'd like, us to be able to consider as we move more and more products, including the treasuries, perhaps there could be an expansion of acceptable collateral, as well as the framework should include the ability for clients to be able to net collateral posted, between various products. And the third, is actually a question. When we're talking about the clearing solution for treasuries, if I could just ask, are we talking about both on the run and off the run? Because off the run is, where, the market could really benefit from having a more streamlined solution, especially since clearing would also lead to better electronic execution. And then the second is in the current solution that we have for repo clearing, does the end client that is trading using this solution, do they 100% face the clearinghouse, or is there still any linkage with the market participant on the other side if there were going to be a material negative event in the market?
Thank you, Ms. Bedbrett. Would any of our panelists like to address any of Ms. Bedbrett's points before I see if there are any other questions?
Yeah, I would be happy to come in on the first of the two questions on clearing solutions for treasuries. Just to affirm the point that the market that would benefit, or the segment of the market that would benefit significantly from that includes for certain the off-the-run treasuries. As the speaker pointed out, it is that is an area where clearing solutions are very slight at the moment. So just wanted to affirm that that is something where we would lean in.
Great. Thank you very much. Do any of our other panelists or do any of our other GMAC participants have any thoughts on what reform proposals or recommendations, whether they were mentioned today or not, would best serve the Treasury market to foster resilience and mitigate against future stresses? As a reminder, if anybody has any comments or questions, please use your WebEx chat function and address your question to all panelists.
Angie, this is Commissioner Stump. I just had a follow-up. I just wanted to make certain that I understood Ms. Vadbrat. The conversation you were having, Suparna, your comments relative to the high-quality collateral in the event that clearing became more prominent in this space. I just want to make sure, did I understand you to say that there would need to be consideration for expanding the types of collateral that would be eligible? I think that's what you said.
Yes.
Okay. So you mean expanding beyond, would you like to elaborate on the types of collateral you think might be good candidates for the expansion? And if not, that's fine. This is a conversation that we have in our markets as well. So.
Yes, so I would say, the idea is obviously that we want to have very liquid, assets that we can use as collateral. Beyond what is already acceptable collateral, what would come to mind are, if we have very liquid ETFs or, in some cases, money market funds. That could also be, part of the suite of the assets that, can be posted, because that would, avoid in certain situations if clients have to, unwind, these very liquid wrappers in order to be able to post the limited supply of high-quality, assets that are currently accepted.
Thank you. That's very helpful.
Thank you, Commissioner Stump. Mr. Coutinho, do you have a question?
Yes, thank you. This question is, or comment is for all panelists. I think there was I don't recall exactly the number of papers, but there were about 2 papers that were put out on issues with liquidity for broker-dealers in the securities clearing market. This is because clients' margin cannot be passed on to the CCP to cover clients' activity. Could anybody among our experts speak to that? I can't believe I left everybody speechless.
I think that question is perhaps better answered by, someone from the broker-dealer community.
Would any other panelists, any other GMAC participants like to address Mr. Coutinho's question before we put it aside for a future day?
Sunil, this is Andre Goldsmith. I think we have a presenter from our next panel who is absolutely willing to cover your question if you can hold off and wait.
Certainly. First time it has happened to me, so thank you.
Thank you, Mr. Coutinho, and thank you, Andre. Mr. Yamada, do you have a question?
Yes, I just wanted quickly to ask on the point of transparency. There was a comment around a difference in transparency or liquidity around off the runs versus on the runs. And given the difference in holders of those securities, has there been an attempt? I understand that the Fed and Treasury have spoken to those end users, but to involve them in this conversation, as it's my view that they would probably be affected by any changes to the information on their trades being disseminated.
Yeah, so it's Michael Padroni here. I'm happy to come in on that. I think the primary area where those, foreign official accounts have had a voice so far is in the context of the Financial Stability Board conversations about reforms that should emerge from the Treasury markets. That's probably the area where they have the most input with respect to transparency. The idea is not in post-trade transparency. The idea is not to divulge the name of the participant, but rather the aggregate anonymized information or the anonymized information on a transaction, so that users of that data aren't privy to who did the trade, but rather at what price and in broad brush terms, what quantity.
Right. I agree with Michael's points there. And again, it is why we are advocating for, a careful and calibrated approach. And so to ensure that with respect to any type of price dissemination, there are appropriate caps. I think the most important thing is creating anonymous, as well as protecting and maximizing the market efficiency and overall market liquidity. So these are all things that need to be considered, when we get to that stage of determining the right calibration.
Great. Thank you, Mr. Yamada, Ms. Hahn, and Mr. Padroni. Does anybody else have any questions or comments regarding this first panel?
This is Commissioner Stump again. I have a question for Mr. Schulhofer-Wohl. I believe you mentioned in your comment that there could be improvements made to data that's available relative to uncleared bilateral transactions. And I just thought I would ask you to expand upon that a little bit. I know we're talking later about our new swap data reporting rules and the improvements we've made there, but I just thought perhaps it might be worthwhile for this audience to better understand what do you consider to be missing and lacking with regard to the uncleared bilateral transactions, and if you were referring to the swaps market there or some other element.
Thank you, Commissioner. It's a great question. Unfortunately, given our communications blackout rules, I'm not allowed to answer any questions today, but I'd be very happy to talk with you or others about that question or any other questions after the blackout period.
That's fair enough. Thank you very much.
Thank you, Commissioner Stump. Any other questions for this panel before we move on to our next item on the agenda? All right, great. Andre, we're running a little bit ahead of schedule, but are you aware of whether the second panel is ready to go on?
Hi, Andy. I think we're still checking. In the meantime, let me do a couple of attendance updates from people who weren't able to respond on the initial roll call. So on the line, in addition to everyone who responded before, we have Ted Backer from Morgan Stanley, Paul Hamill from Citadel Securities, Joe Nicosia from Louis Dreyfus, Murray Posmanter from DTCC, Maggie Sklar from the Federal Reserve Bank of Chicago, and Jessica Soul from HC Technologies. I might suggest, while we're just making sure that we have all of our panelists up, that we take maybe a 5-minute break and reconvene here just before 10.
That's perfect. we'll talk to everybody right before 10. Thank you.
Right.
Stanford University. Please go ahead, Professor Duffy.
Thank you so much. It's a pleasure to be here. Normally, when I talk about this subject, I would start from base principles, but I think given everyone that's here today, I'll just start with going right into the key issues. I prepared 4 figures, and if you have those in front of you, the first figure is one that should be familiar to most people here. It's an illustration from the General Accounting Office of bid-offer spreads in the off-the-run and the on-the-run market leading into and coming out of the March pandemic declaration. And clearly, bid-offer spreads widened out dramatically in the interdealer market. I want to emphasize what's happening in the dealer-to-customer market, which, since we don't have trace data for the dealer-to-customer market, or any market for that matter, it's best to look at it in terms of Bloomberg data. And you can see a very dramatic degree to which market participants were having trouble getting liquidity. And that's evident in many other forms of analysis that probably everyone present has seen a great deal of in the last year. It's sometimes said that when these problems occur, the Fed can come in and fix this situation, and that while it doesn't happen very often, it's okay to leave it up to the Fed. The diagram shows that it took a number of weeks, despite the massive reaction of the Fed, very good reaction. It took a number of weeks before the bid-offer spreads went back to normal, and all other indications of market depth and market function also took weeks to recover. So we really can't leave this up to the Fed. Purchasers around the world of treasuries were relying on the ability to liquidate their treasuries during a stress period just like this one. That's why they paid a premium for U.S. treasuries, so that they would serve as a safe haven. So market structure needs to be addressed, and today we're talking about central clearing as a way to address this. Central clearing has a number of benefits, including lowering the commitments of dealers and freeing up space on their balance sheets, and also at least providing a chance for all-to-all trade to relieve dealer balance sheets of some of the need to handle these massive flows during a crisis period. On the next slide, I show the ratio of treasuries outstanding to total primary dealer assets in the decade before the financial crisis and the 13 years or so since then. And it's pretty obvious from the diagram that dealer balance sheets were keeping up very well with the growth of the treasury market before the crisis. At that time, dealer balance sheets were not very heavily constrained by regulation, and dealers were getting pretty cheap funding because it was presumed that they were too big to fail. Since then, regulators and market participants have learned their lesson, and dealer balance sheets have been much more constrained. Meanwhile, the Treasury market has been growing by leaps and bounds. As of 2020, it was around $20 trillion. The Congressional Budget Office predicts that by 2050, it will be $120 trillion. So this is one of those trends that's not sustainable. Dealers will not be able to manage stress periods as the Treasury market gets bigger and bigger. On a normal day, everything is fine, but exactly, again, when large customers want to liquidate large positions during a very heavy stress period, they won't be getting the safe haven services that they thought that they had paid for. On the next slide, I'm showing broad central clearing effects from analysis by Michael Fleming and Frank Keene at the Federal Reserve Bank of New York. So this is, in some sense, what would happen in a counterfactual world in which all participants centrally cleared. That might be optimistic, but I think you get the picture from the diagram that the amount of settlement commitments would go down on peak days from over $1 trillion last March to the mid $200 to $300 billion range. So a very, very dramatic reduction in dealer commitments to settle. And that's very important, obviously, not only because of the regulatory capital requirements, but because of the reason that central clearing came into the market in the first place, is that it reduces net settlements dramatically and it lowers counterparty risk. It also makes the market more transparent, and it also gives market participants a sense of what margin requirements are broadly in the market. Central clearing is not to be taken for granted. Of course, it must be very well regulated, and I'm sure we'll hear more about that later today. On the last of the 4 slides that I prepared, I put special focus on the implications of settlement failures, which soared dramatically during mid-March. As dealer balance sheets got very clogged up, it was more and more difficult to finish trades as promised, and settlement failures grew to an excess of $500 billion a week in the primary dealer market. FICC fails were somewhat less. My view of this is that because trades at FICC tend to cut off the daisy chain failures by which A fails to B, which then causes B to fail to C and causes C to fail to D, and so on. Fleming and Keene show that the effective netting at FICC would have reduced settlement fails in the counterfactual world of broad central clearing by an enormous amount, at least in the most heavily traded securities like the on-the-runs. I know that we're going to discuss mostly, I hope we will discuss today, mostly the how we do this. The DTCC paper very elegantly says it's not a question of whether to get broader central clearing, it's how to do it. And I know that we're going to focus on the details. The FIA paper put together by principal trading firms provides a lot of clues about how to do that. I hope we will zero in on the recommendations in that report. And Laura Klimple today, I believe, will help us understand where the impediments might be and how FICC can help with this. So I'm in listening mode when they speak. I want to learn from both of them how to remove some of the roadblocks. Their work suggests that there are avenues by which a lot more could be done without going to a very heavy regulatory mandate. And if a mandate is needed, and it may well be, they also provide clues as to how to do this without causing undue costs or even possibly worsening the performance of the market for certain segments of market participants. So with that, I'll turn it back to our host. Thank you very much.
Thank you very much, Professor Duffy. The second presentation will be from Graham Harper, Executive Committee member of the FIA Principal Traders Group and Head of Public Policy and Market Structure at DRW Trading Group. Please go ahead, Mr. Harper.
Thank you, Angie, and good morning, Commissioner Stomp and Chairman Benham, Commission staff, and GMAC members. On behalf of the FIA Principal Traders Group, I appreciate the opportunity to present our July white paper on Treasury clearing here today in front of the GMAC. The FI Principal Traders Group is an association of firms that trade their own capital on exchanges in futures, options, and equity markets worldwide. Many of our members are active participants in both the cash, treasury, and repo markets, particularly in the electronic IDB market. Ongoing regulatory discussions related to the lack of growth in central clearing and treasury, cash, and repo transactions, including possible clearing mandates, prompted us to highlight what we believe to be obstacles to voluntary clearing and issues that would certainly need to be resolved prior to any mandates being implemented. If we can move sort of past the table of contents here. So, as noted on, we're supportive of the ongoing efforts to increase central clearing and treasury markets based on the many benefits we believe clearing brings to markets, namely improvements to market resiliency, market liquidity, and market transparency, as noted in slide 3. We've consistently advocated for the importance of central clearing in other asset classes, including swap reforms undertaken by the CFTC in accordance with Dodd-Frank. And there are some lessons we feel are helpful from that experience, which I'll touch on a bit later. As noted on slide 4, currently uncleared cash treasury transactions account for more than 75% of the secondary market uncleared bilateral repo account for approximately 50% of the U.S. repo market. And the vast majority of Treasury clearing at FICC is done by direct members, not through client clearing. Of the greatest importance in our view to increase central clearing is the need for a client clearing model that all market participants can access and utilize. And irrespective of asset class, most market participants, including buy-side investors and many PTFs, access central clearing through a client clearing model for a variety of reasons, which are laid out in the following slide. It's critical for a viable client clearing model to exist in order to provide true access to large swaths of the market. We appreciate the efforts FICC has continued to make to its current client clearing offerings, but we still see issues that warrant attention. A brief description of each of those offerings and their existing limitations are shown on slides 6 and 7. Of the issues we identify in the white paper, none are more important than the current ability of clearing members in the sponsor model to discriminate based on execution counterparty, what are referred to as, quote, done with trades, where the sponsor has the ability and in practice does only accept transactions that are executed with them. The FICC sponsor clearing offering could provide market participants with a viable client clearing solution if clearing members were not permitted to discriminate based on execution counterparty. And I'd point out, particularly given the audience today at the CFTC, that similar issues were raised by market participants and ultimately addressed in the CFTC swap-related rulemakings during the implementation of Dodd-Frank. CFTC rules prohibit any arrangement that discloses the identity of a client's execution counterparty to its clearing member or otherwise limits the number of counterparties with whom a client may trade. In addition, in order to further facilitate client access to clearing, the CFTC requires clearing members to comply with detailed conflicts of interest requirements, including operating independently from affiliated trading businesses. These steps have successfully expanded client access to clearing and CFTC-regulated products. Sorry, I forgot to skip the slide. And I should point out my power went down right before this started. So if you hear a generator humming in the background, I'm not cutting the grass. So if we could skip forward on the slides. To that. Thank you. We recommend that FICC, in coordination with relevant regulators, implement similar enhancements to its client clearing offering so that it's available to all types of market participants. In particular, we think FICC should remove the ability for sponsored clearing members to discriminate based on execution counterparty, require clearing members to operate independently from affiliated trading businesses when deciding whether to offer clearing services to a particular client and the associated commercial terms. And then in addition, the FICC and CME should permit both direct clearing members and clients to utilize cross-margining arrangements on fair and non-discriminatory terms, which we also acknowledge would require some regulatory intervention as well. And finally, FICC should ensure clients are adequately represented in CCP governance processes, including risk committees, and the working groups involved in determining the rules and design of the client clearing model. We look forward to continuing working with FICC, the clearing member community, and the various regulators to continue to move towards truly viable client clearing model for Treasury markets. And again, thank the CFTC and the GMAC for the ability to add our voice to this important discussion.
Thank you, Mr. Harper. The third presentation will be from Laura Klimple, General Manager of Fixed Income Clearing Corporation. Please go ahead, Ms. Klimple.
Thanks very much to Chair Benham, Commissioner Stump, and the Global Markets Advisory Committee for having me here today. In terms of describing what the benefits could be derived from increasing central clearing in the U.S. Treasury market, my fellow panelists have done a great job of covering the waterfront of benefits. However, the only other benefit I would add to the list is mitigation of fire sale risk, which I would argue should be one of the top priorities for the official sector when thinking about how to make the Treasury market more resilient to withstand future stresses. Specifically, what I mean is that a central counterparty is uniquely positioned through its ability to centralize and consolidate the liquidation of a defaulted market participant in a manner that minimizes risk of loss and the risk of market disruption that cannot be avoided if individual bilateral counterparties are required to each act on their own outside of central clearing to liquidate the defaulter's collateral. In terms of accessing central clearing, we wholeheartedly agree with the PTG that we require viable client clearing models by which market participants that either can't, for regulatory or other reasons, become a direct member of FICC, or who choose not to because it does not align with their business model, have means to access central clearing, and that having client clearing models for this reason is critical, especially if we are considering expanding the amount of Treasury activity that FICC clears. That said, what the prior presentation characterized as material limitations in fixed various client clearing models, we would characterize as options, each of which has important use cases that are necessary to support access to clearing for the diverse array of market participants in the U.S. Treasury market and the varying types of Treasury activity they clear at FICC. I'd like to first start with FICC's correspondent clearer model and prime brokerage model. The PTG is correct as they depict in their slides, and as we note in our most recent white paper that has been submitted for the committee's consideration. In those models, the underlying client does not become a member of FICC, and as such, FICC in neither of those models has direct obligations to them, only to the correspondent clearer or the prime broker itself. This allows FICC to net the margin associated with the activity in the core clearer's or prime broker's account, including across clients, which in most cases will result in a reduction of margin costs for the clearing intermediary. This type of margin efficiency may be very valuable to a given client and its clearing intermediary in terms of reducing the clearing costs, especially in cases where the primary motivation for participating in central clearing is to take advantage of FICC's multilateral net settlement process to make the settlement of their Treasury transactions more operationally efficient than it would be outside of central clearing. This is the point Daryl was making earlier. Rather than, for example, the benefits of novation to and credit intermediation by FICC. If market participants and their clearing intermediaries value that more, they might elect for the sponsored clearing model instead. And to BlackRock's question, in the sponsored model, there is a true novation of the market participant, i.e. BlackRock's positions to FICC, and the market participant as the sponsored member would have direct obligations to FICC, and FICC would have direct obligations to it, including guarantee of performance on its activity. The prior presentation also noted that minimal repo is flowing through the correspondent clearing and prime brokerage clearing models today. We'd agree that statement. Of the 80+ billion we see flowing through those models daily, the majority of that activity is Treasury cash activity. We believe this to be the case because, as we discussed in our white paper, these two models have been designed and primarily used for agented style clearing akin to the FCM model in the derivative space with respect to Treasury cash transactions. The accounting analysis necessary to be comfortable acting as an agent clearer for repo is something that most dealers have yet to do, largely because it hasn't been necessary, because they could just keep that activity outside of central clearing. That said, this dynamic is beginning to change as we work with more agent clearers to bring their client activity into FICC. And the accounting work previously done by FCMs to get comfortable acting as agent clearers in the derivative space has been very helpful in this regard. Switching gears to discuss sponsored clearing, the PTG note that FICC does permit transactions of a sponsored member client to be executed either with the sponsoring member itself or with a third party. This allows sponsored activity to be executed both on an anonymous interdealer broker platform, akin to exchange trading in the derivative space, or bilaterally. FIC believes it is essential to its ability to fulfill its obligation to provide fair and open access to central clearing that it retain all of the client clearing models that it currently has, as the array of market participants in the Treasury market is very diverse, such that a singular model for client clearing will not work and will actually have the adverse consequence of disenfranchising many market participants from clearing. As an example, money market funds regulated by the SEC under the Investment Company Act of 1940, including SEC Rule 2A7, are critical liquidity providers to the Treasury market. These funds do not typically participate in the derivatives markets and are not capable, from either a regulatory or an operational standpoint, to participate in an agented-style give-up client clearing arrangement like the FCM model, where the agent clearer would look to charge back all of the costs of clearing, including margin, liquidity, loss mutualization, and fees, to the client. 2A7 funds are not permitted regulatorily and are not operationally set up to absorb those types of chargebacks. The only practical means they have to compensate their clearing intermediary is through a spread on the activity, which allows the clearing intermediary to absorb the cost of clearing for them. And there are other types of regulated buy-side firms in the Treasury market that are similarly situated. In order to avoid disenfranchising those communities from having access to central clearing, FIC believes it is essential to have client clearing models that allow for principal trading between clients and clearing intermediaries, such that the client can pay the intermediary a spread on its cleared activity to compensate the intermediary for the cost of clearing. The counter concern articulated by the PTG is that because FIC permits clients to trade principal with their clearing intermediaries, and clearing means that intermediaries will be reluctant or unwilling to provide them with agented-style clearing services at FIC. To pressure test this concern, FIC has proactively reached out to FCMs that provide agented clearing services to PTFs in the derivative space and inquired as to whether they would be interested in extending their offerings to Treasury clearing through FICC. We have been met with great enthusiasm by those firms and are actively working with them to roll out agented-style clearing offerings at FICC. So we believe that partnerships between like-minded clients and clearing intermediaries are viable, notwithstanding the fact that FIC offers other styles of client clearing to service other communities that are differently situated. That being said, there is definitely still more work to do to ensure the viability of increasing client clearing at FIC in connection with a potential Treasury clearing mandate. And some of those items will require public-private partnership to resolve. First, and I believe prior panelists have touched on this, we need to improve the efficiency of cross-margining between cash and derivatives, namely the FIC CME cross-margining arrangement. The current cross-margining arrangement is being actively worked on to enhance cross-margining efficiency, and we hope to roll out an enhanced model by June 2022, subject to regulatory approval, of course. One of those approvals will need to be from the Commission. That current arrangement only covers the proprietary positions of common FIC CME members. A cross-margining arrangement covering positions held by customers, as between FIC and CME, has never been approved. And we look forward to working with CME, the Commission, the industry, the SEC, the Fed, and others to make customer-level cross-margining a reality. And of course, when we receive approval for that type of arrangement, our rulebook will be revised accordingly. The next point I want to raise, and this was something that Sunil pointed out earlier, another area where public-private partnership will be required to improve the efficiency of client clearing at FICC relates to the treatment of margins posted by a client to a clearing intermediary for FIC activity. Unlike in the derivative space, where it is commonplace for FCMs to rehypothecate margins pledged by clients to them onward to the DCO, and there is no penalty to the FCM for doing so, a clearing intermediary at FICC is not permitted to rehypothecate client margin without reserving commensurate funds according to the reserve calculation prescribed by SEC Rule 15C33. What this does is it effectively requires clearing intermediaries to use their own funds to cover margins at FICC, which makes it very challenging, especially for agented clearers, to offer client clearing of treasuries at scale through FICC. We look forward to working with the broker-dealer community and the SEC to operationalize the type of relief required to allow broker-dealers to rehypothecate margins received from clients to FICC, similar to the type of relief that Options Clearing Corporation has obtained in the past. And the last area I want to point out where there is still work to do relates to FICC offering locked-in style trading and clearing relationships for the PTFs and their clearing intermediaries. In other spaces, FICC offers the ability of clients and their clearing intermediaries to establish locked-in trading relationships such that all trades executed by a client are sent directly to the CCP locked in without a need for matching at the individual transaction level. We have a similar construct in the equities clearing market. We want to work with the PTS and their clearing intermediaries to put that style of locked-in trading and clearing in place for them, as we believe it to be best suited for their business arrangements and trading practices. So with that, I will stop there and ask if there are any questions, or otherwise yield back to our host.
Thank you very much, Ms. Klimpo. The floor is now open for question and comments on our presentations in panel 2. As a reminder, if you have any question or comment, please use the WebEx chat feature on the bottom right of your screen and send a message to all panelists. While we're waiting for people to gather their thoughts, Mr. Coutinho, you had a question raised earlier. I know that Ms. Klimpo touched on it. Do you want to ask it again, or was it answered?
No, I think Laura did a wonderful job answering that. I think it's important to understand that the structure for clearing in the Treasury's world needs to change for it to be accepted broadly. So I think Laura covered it. A lot of the clients cannot be direct members. That's true. And to support a broad base of intermediaries who can provide clearing access, it's important to make it capital efficient. So, and also from a risk perspective, we need to remove the liquidity risk pressure. So what Laura points out is actually the source of liquidity stress in the securities market early this year. We saw that through meme stocks. So if we don't put in place those reforms, I think you cannot expand clearing to a broad base of clients coming through intermediaries. So I think thanks to Laura for actually raising that. And the second piece, I think Laura is right. Cross-margining is very important. In many cases, it's a prerequisite. Unfortunately, it's limited to only direct members. The ideal cross-margining program is the one we have at the Options Clearing Corp. So putting in place such a cross-margining program will only enhance the incentives for clearing. Otherwise, there are a lot of constraints to actually grow clearing access.
Thank you, Mr. Coutinho. A question for all of our GMAC participants and panelists. We've heard a lot about the benefits, potential benefits, to increase clearing of treasuries. Does anyone have any views on any challenges or impediments that should be considered in order to increase central clearing beyond what has already been raised, or perhaps to emphasize some of the points that have been raised by some of our panelists?
I would like to, this is Suparna from BlackRock. I would just like to ask a clarity question, at the back of the question I'd asked after the previous panel.
Please go ahead, Ms. Bedrat.
Well, thank you for the information on explaining how a client like, the BlackRock, would novate the trades to FICC. My follow-on question, and this is, purely for clarity's sake, if you could help me understand, when the trades are novated to FICC, does the original, counterparties have any residual risk, to one another as the original executing counterparties, especially, in the event of a default? Because today, when we clear for cleared swaps, that link with with the original executing counterparty is completely broken. We are 100% facing, the clearinghouse, whether it's CME, LCH, ICE, what have you. So if you could, just help me understand, that piece, because that's very critical to the way we would look at, the risk to the clearinghouse itself, as we move into this model.
I'm happy to take that. This is Laura. So thanks for the question, Suparna. So and what I alluded to in my prior remarks, when we're talking about sponsored clearing, a BlackRock fund would become a direct limited member of FICC, and there are many BlackRock funds that are participating in repo clearing through FICC today. So when that happens, and when a transaction is novated to FICC, FICC will become, through the novation process, the obligor to BlackRock on that transaction, such that if there is a default of the intermediary or any other member of FICC, FICC is obligated to perform to BlackRock under its CCP guarantee. Now, in terms of whether there is still a relationship maintained between BlackRock and whoever it chooses to use as its clearing intermediary, the answer is yes in two ways. Number one, the clearing intermediary retains the responsibility to act as BlackRock's processing agent for all transaction submissions, settlements, et cetera, to the CCP. They continue to be the pipes and plumbing of BlackRock to the CCP. And number two, they retain a responsibility to FICC to be a guarantor of your performance to us. So they retain a processing agent responsibility and a guarantor responsibility post-novation, but FICC will have separate obligations to BlackRock to perform on its transactions, and that's why in the sponsored model, as we talk about in our paper, that product is gross margined, such that we hold individual VAR-based margin for each underlying sponsored member, such that we can guarantee performance to them separately. I hope that answers your question.
Yes, thank you. So because of this linkage, answer to your question, I think the scalability, of adding, funds or, accounts to the model, may be a little bit cumbersome because we would have to keep in mind what is, the counterparty exposure beyond just the clearinghouse. So that's just something to point out, that we don't have that issue in the swap clearing model.
So I guess I would point out, the other option would be to come in as a direct participant. You'd need to have a regulated entity in order to become a direct member of FICC. So that's also an option, in which case you wouldn't need to be relying on an intermediary at all, and would avoid that possible linkage. But I would just note that there are other ways to mitigate the type of what I would call settlement agent risk that otherwise is necessary in this type of a structure, and that would be through diversification of intermediaries. We have most of our major asset managers in the product have, at least 2, upwards of 10 or more sponsoring members in the product. So that's another means by which to mitigate that risk.
Thank you.
Thank you both. Professor Duffy, I believe you may have a question. Could you please go ahead?
Yes. I have a question about the FIA paper's suggestion that it's problematic when one's clearing member is also one's dealer. What would prevent PTF from clearing through an existing member of FICC that's also not active as a dealer, like a large custody bank, say Bank of New York Mellon or State Street? Might this avoid the conflict of interest that's mentioned in the FIA paper?
Professor, it certainly could. I mean, the current issue is that there just aren't sponsors offering the services that most of our members are looking for, be that clearing cash for the most part generally, or any sort of portfolio clearing, which is, with a predominant amount of the transactions occurring through IDB venues, the portfolio approach is something that I think most people need rather than just one-off trades being cleared. So to Laura's point, the rule book does allow for that. The problem is commercially that option doesn't really seem to be available.
That's interesting because one would think a firm like Bank of New York Mellon has all of the necessary capabilities technically, operationally, and would find this an interesting business opportunity as well.
But Daryl, they have to finance the margin and the clearinghouse.
Everyone wants to seem... I just wanted to say, I noticed a thread throughout the discussion in the papers is that there are fees costs that lie in the way of all this happening, and yet nobody wants to pay to protect everybody else in the market from themselves, and yet there is a need to do that. It's a common good when people are forced to pay fees that protect everyone from everyone else. So I don't expect voluntarily people will pay fees.
No, but there is a cost. The cost threshold is too high. So in a futures world, that's what happens. There are a lot of clearing members that provide clearing services that are not participants in the market. They just clear. They're not liquidity providers in the market. They just clear. They cannot. That option is not accessible.
Right.
And then the second thing is there is a liquidity cost to actually supporting clients.
Ms.
Right.
Did you want to add onto that?
I did, yeah. I just wanted to point out that, further to Sunil's point and my prior remarks, I think most likely the more the road to go down that's probably going to be more fruitful is in bringing intermediaries that have business models where they are built to do agented clearing like FCMs, to have them translate that offering into the Treasury clearing space, because they're already comfortable, not serving as as execution counterparties, but just providing clearing services. They're comfortable doing that in the derivative space for PTS. And now the work is to translate those types of offerings now to the Treasury cash market. And that's where the issue around rehypothecation of margin and making sure that is not penalized under SEC regulations is key, because those FCMs that are used to providing the service in the derivative space have not had that friction previously. It's a unique regulation to the cash market that needs to be addressed in order to ensure that the economics can be equivalent as between the agented clearing services they offer in derivatives versus in the cash market.
This is the 15C3 point in your paper. Is that right, Laura?
Yes, Darryl. Correct.
And has the SEC been made aware that this is an impediment, and are there any advantages to the existing 15C3 rules, or is this simply an obvious thing that needs to be done but hasn't been done yet?
I mean, I think to answer your question, certainly we've discussed it with them. I would argue that the issue has not really come to a crescendo until now because, as I noted in my prior remarks, agented type activity in a lot of cases happens outside of central clearing, Darryl, because there isn't a clearing mandate. So now as people look to bring more and more activity into central clearing for a host of different reasons, including agented style clearers, that's where this issue really comes to a head, and it has to be addressed. And I would say this is both for firms that are used to transacting as FCMs in the derivative space, as well as prime brokerage activity. Figuring out how to make sure that that's economical, I think, requires a look at C3 and relief, similar to what OCC has gotten in the past.
Thank you. Well, just as a follow-up, let's suppose that pathway were cleared. Would clearing members that are dealers then have sufficient incentive to provide this clearing service without requiring without running into the impediments mentioned in the FIA paper about combining clearing and counterparty trading? Or would there remain a conflict of interest?
I mean, just speaking for FIC, I think that it certainly isn't going to be in every dealer's business model to offer agented clearing services, but there are some, and those are the ones that we are working with, right, to make sure that. And they've expressed that they want to offer this service to their clients, including to the PTF clients. But one of the roadblocks that needs to be addressed in order for it to make economic sense for them to offer this service at scale is the C3 relief. So I think it's more about enabling people who have agented clearing models to leverage that model in this Treasury market. You know, I think that's probably the most productive path to go down.
I think also the ability to have cross margins,
yes,
will help because at the end of the day, clearing is a volume game. So being able to reduce the collateral cost as well. The amount of collateral you post and your capital against the trades can benefit if they are allowed to have the ability to offer cross-margining.
Thank you, Ms. Klimple and Ms. Vedbrat. Professor Duffy, did you have any other questions?
Well, I don't want to monopolize the questions, but I did have one about the pending business of market access, which is suggesting it's going to provide all-to-all trading services. I don't see I'd like to hear more about the scenario by which, once that business builds up to a sufficient scale, it can be centrally cleared. I imagine that market access won't have the necessary balance sheet to centrally clear it on its own.
I'm happy to speak to that unless there are others.
Yeah, please go ahead, Ms. Klimpo.
Sure. So, Daryl, yeah, I agree that that central clearing definitely enables all-to-all trading, and it certainly has historically in terms of intradealer broker activity, or at least part of it that whereby in the case of repo, all IDB trading comes through the CCP because all participants in that market are either members of FICC or clients of a member of FICC. So I think that definitely, all-to-all trading and clearing go hand in hand, and certainly the more intermediaries that we have in central clearing, including agented clearers who are willing to offer a business where their clients are allowed to execute on all-to-all platforms, and they effectively wear the risk of that activity to the CCP. I think that central clearing can go a long way to growing those markets.
So your agented clearing model would be the model for a trade platform of this type.
It would have to be, right, because the other types of client clearing that we offer are where the trading counterparties are the client and the clearing member, which, as in my prior remarks, I talked about is essential for some of our more regulated buy side that can't otherwise participate in an agented style clearing model where they would have to be charged back all the costs. But for those clients and their intermediaries that are looking to do an agented style client clearing arrangement, then yes, that's where I would see all-to-all fitting in, as well as for direct members of the CCP.
Thank you.
Ms. Vedbrat, did you want to add anything to that?
I was just going to, suggest that we think about the execution platform, separate from, the clearing, because you can't have electronic trading without clearing. And then, the electronic platforms, even today, if you look at some of the other products that, that we see centrally cleared, the products can execute on their platforms, and then they go to the clearing houses to be cleared. So, the question on market access, what market access does is it does allow you to have, to choose who your counterparty is. And in the event that you don't want to, in the all-to-all trading, their broker-dealer would step in the middle. So I think it's progressive, where we can end up, linking the execution of treasuries with whenever the clearing model is, ready for large-scale clearing, without, too much of, too much work on the electronic trading platforms part. Like we've done it in the past, and even if you look at the models today, they work pretty well.
Thank you, Ms. Vedbrat. Does anyone else have any questions or comments for our panelists?
Hi, it's Amy Hong at Goldman Sachs.
Hi, Ms. Hong. Please go ahead.
Hi. I just wanted to take a step back. As the panelists have cited, central clearing can deliver important benefits to markets, including operational efficiencies, reduced risks, enhanced transparency. And data supports that broad-based central clearing would have reduced counterparty risk in the system. But it's not apparent that it would have created incremental risk capacity nor relieved the supply imbalance that was a key issue in spring of 2020, as even with netting, the market was heavily one-directional. I'd appreciate the panelists and other committee members' suggestions on how to evaluate whether broad-based clearing would have relieved the market stress we witnessed, particularly for off-the-run treasuries.
Well, this is Daryl. I'll take first shot at that one. just a moment ago, we discussed the possibility of an all-to-all trading venue that doesn't require use of dealer balance sheet. Dealer balance sheets were the scarce resource last March. It wasn't simply that it was a one-sided market. It was also the fact that all of those trades had to go across, from a customer side, had to go across a dealer balance sheet and basically clogged up those balance sheets so badly that the dealers were not interested in taking more trades except at a very large bid-offer spread. And that's fair game for them. They made a lot of money last spring, but their balance sheets were the constraining element of the market structure. If central clearing were more broadly available, a lot of trades would bypass dealer balance sheets. A buyer, an ultimate buyer, say a hedge fund, could sell to an ultimate, could buy from an ultimate seller like an insurance company or a foreign central bank on an all-to-all platform. So that's in one respect. There's another respect, which is that when trades fail to settle, they start to add to the dealer capital commitments. And settlement failures were rampant last March in the hundreds of billions of dollars a week. That would have also, central clearing would have reduced those settlement failures dramatically and also freed up a lot of dealer balance sheet. So that's two examples by which central clearing might have made more space available on dealer balance sheets. There are other opportunities, but I don't want to monopolize the answers to this question. Maybe my colleagues on that panel might have other points to make.
But Darrell, aren't you assuming that when there is a large selling pressure, that there is a buyer on the other end, because the dealer is an intermediary? So there are two choices, right? They either warehouse it and they sell it eventually to the ultimate buyer, or they, have a buyer ready to buy, and the problem is a transient one. I think that's where Amy is coming from. Now, I don't know the entire dynamics that well. Are we sure that during the spring of 2020 that there was a buyer there to absorb all that selling? That's the question, I think.
Okay, let me address that one head on, because I have heard that there were only sellers and no buyers. In the equities market, there were a huge amount of sellers. The price dropped dramatically to the point at which buyers came into the market. In the Treasuries market, that could not happen because the dealer balance sheets were constrained. In a market as broad as the U.S. Treasuries market, there will always be buyers if the price gets small enough. Of course, the concern is that prices will have to drop to clear the market, but that's a normal state of affairs in a crisis. Sometimes Treasuries appreciate in market value in a crisis because they're a safe haven. Last March, because it was very difficult to use the Treasuries market, the Treasuries were not viewed as a safe haven. So I think there's a kind of self-fulfilling aspect of everyone wanting to sell and few being able to buy because dealers were constrained in the degree to which they were willing to intermediate at narrow bid-offer spreads. Markets tend to function when you let them, and markets do tend to clear when there's market structure is able to match buyers and sellers quickly enough.
I'd like to jump in if you don't mind. This is Laura. So I agree with almost everything that has been said. And there's definitely, when it comes to central clearing, there is some balance sheet and capital constraints that central clearing can help alleviate, and some that it can't, particularly when dealers have to increase the amount of inventory that they're holding. But I think the important point and where central clearing, becomes really, really important is at these times when there is a supply-demand mismatch where we see the market under stress. What central clearing does very well is it protects the system in the event that type of a stress should create, circumstances such that one or more market participants default. Right? So it's the downward spiral of the stress causing members to default, which is where the clearinghouse can come in and stabilize the situation by mitigating fire sale risk, doing liquidations in an orderly fashion, and otherwise stabilizing the market. So I think, can central clearing solve for all types of rate volatility and stress? No. But the idea is that it can provide the system with more resiliency to absorb those types of stresses and potential defaults that come therefrom.
This is Joe Nicosia with Louis Dreyfus. Question. Have you given a thought of the size of the capital that is necessary in order to perform the clearing function? Because as we've seen in past years, stress in a clearing function in and of itself can be more devastating than stress within the marketplace. And so in order to attract enough capital, obviously you have to be able to make the returns proportionate enough to risk that capital. And as you do that, with the size of this kind of marketplace, you either can have a situation where you have to attract a lot of capital with higher costs, or you get cherry picking that takes place within those things that get cleared, in which case only the higher risk trades or those with lower credit risk get allocated to the clearing function, thereby raising the risks that take place on the clearing side. So has that been analyzed, especially with the level of capital that will be necessary?
So this is where I'll take that question. So definitely, let me talk about the regulation of FICC for a minute, because I think it helps to answer the question. So FICC is an SEC-registered covered clearing agency. It has been designated as systemically important, and so it is subject to strict supervision both by the SEC as its primary regulator as well as by the Federal Reserve. So the models that we use to charge for margin, charge for liquidity resources that we require are heavily, heavily scrutinized by our regulators, very, very frequent exams, et cetera. In addition to that, FICC is a utility. So we are aligned with our owners in the sense that our owners are also members of the CCP, such that we allocate to each clearinghouse the regulatory capital that it requires in addition to a corporate contribution to the waterfall. So we believe, that those resources, in addition to the margins, liquidity resources that we charge to our members, allow for
on the experience of exchanges and regulators.
Sorry, I think somebody was speaking. They allow us to be able to absorb the cost of increasing the scale of Treasury clearing, and obviously to the extent that more activity will be coming into central clearing, most likely the resources that we were required to collect will grow.
Sorry, this is Masi Yamada from JP Morgan. Just on that point, when you're collecting those resources, is it contemplated that that kind of pool of backstop funds will be distributed amongst the new participants as well, and that those new participants will be held to the same regulatory capital adequacy requirements as the current members?
So that's a great question, Masi, and it depends upon how they come into the clearinghouse, and let me explain that. If they come in as a direct member of the CCP, then they will be responsible for if there is a default loss, for example, covering their proportionate share of that loss mutualization, just as any other direct member of the CCP. If they come in through a client clearing model, their clearing intermediary will be responsible for those same costs, including the costs of related to the client's activity, such that every intermediary or member is going to be covering their fair share of the burden. And to the extent that the client and the clearing member, it's part of their business terms, those potential costs associated with loss allocation could be charged back. So either way, the mutualized cost will be absorbed either by the member itself or by the intermediary if it's clearing on behalf of a client.
Thank you, Ms. Klimple. Do we have any final questions or comments for this panel before we take a break? As a reminder, it's very helpful if you use the WebEx chat function if you wish to speak, just so we can manage this remote environment efficiently. All right, well, thank you all very much. Second panel has now ended. At this time, we will take a 15-minute break before our last panel of the day. Please reconvene on the line shortly before 11:15. Thank you.
Thank you.
Welcome back, everyone. We will now move on to the third and final agenda item for this morning, which is a series of presentations on the implementation of various rulemakings under Dodd-Frank. There are 3 presenters for this panel. Tara Cruz, Global Head of Infrastructure, Data, and Non-Cleared Margin at ISDA, Kyle Brandon, Managing Director and Head of Derivatives Policy at SIFMA, and Colin Lloyd, Partner at Cleary Gottlieb, Steen and Hamilton. Please go ahead.
Thank you, Angie. This is Tara Cruz. My thanks to Acting Chair Benham, Commissioner Stump, and the GMAC for the opportunity to present on these important topics. The first one of which is swap data reporting. On November 25th, 2020, the Commission published amended versions of its Part 45, 46, and 49 swap data record keeping and reporting requirements, and its Part 43 real-time public reporting requirements. The amended versions of these rules significantly overhaul the list of required reportable data elements with the clear intention to improve the quality and consistency of the data available to the Commission to understand derivatives trading practices and exposures. The majority of the changes to the data elements are based on a published list of critical data elements, or CDE, published by CPMI and IOSCO, and developed through collaboration among global regulators, including the CFTC. The incorporation of the CDE by global regulators into their jurisdiction-specific trade reporting requirements is intended to improve consistency and accuracy of reported data across regimes. The CFTC publication of a separate technical specification for the Part 43 and 45 requirements is helping the industry understand with greater precision the definition, allowable values, and formats for each data element. Although helpful, the technical specification is not a panacea. Swap data repositories and market participants are working to reconcile inconsistencies between the technical specification and the rule to inform their technical builds. The updated final version of the technical specification was published on September 30th of this year. This created a chain reaction as each SDR will need to provide updated final messaging specifications, and reporting counterparties will need to build corresponding changes to their logic with just 7 months until go live. Next slide, please. On May 25th, 2022, the CFTC will be the first regulator to go live with amended trade reporting requirements which incorporate the CDE. The requirement to report a unique product identifier, or UPI, will apply at a later date, once the UPI system is stood up and the UPIs are ready to be issued by ANA DSB, the UPI service provider selected by FSB. A third implementation date is expected once the ISO 20022 standard has been updated and republished to incorporate CFTC-specific data fields. CFTC reporting counterparties, SDRs, and relevant market infrastructures are actively working to implement the amended versions of the Part 43, 45, and 49 rules for next May. However, this is no small feat. Significant resources are required to interpret the new rules and change reporting logic for the 128 required data elements for various asset classes and a variety of products. Next slide, please. The major challenge with implementing the trade reporting requirements in a consistent, accurate manner has always been the need for parties to translate what is in the written rule into internal code that produces the message sent to their SDR. There is interpretation risk, whereby variations in reported data between reporting counterparties for the same field or product result from isolated internal interpretation of the rule requirement for a field for various products with unique features. This risk has historically been mitigated in part by best practices agreed in ISDA working groups that address specific use cases. Use of the CDE and the technical specifications by the CFTC introduces more granular instructions into the process. elevating the starting point and reducing the scale of use cases for which interpretation is required. But these written instructions cannot eliminate the risk, as it's still necessary to determine for each asset class, each product type, and each variation on a product which terms of the transaction are appropriate to report and in what form. For example, it's not straightforward for all products which party should be designated as the buyer versus the seller, or the payer versus the receiver. Likewise, it is necessary to determine for each product when a notional quantity should be reported rather than a notional amount. These decisions then need to be transformed into machine-executable reporting code. Next slide, please. This is a global challenge, and one which ISDA is addressing with the active collaboration of market participants who are contributing their SME knowledge of various products and their coding skills to develop mutualized open-source code for trade reporting using the common domain model. The Digital Regulatory Reporting Initiative, or DRR, is currently prioritizing the CFTC's amended rules since they have the earliest compliance date. However, modeling has progressed for the EMIR refit version of the EU trade reporting requirements, and a large percentage of the CDEs which are being coded for CFTC can be either fully or partially reused for EMIR. As other jurisdictions finalize their amended rule sets, the DRR can be extended by adding any jurisdictional variations on the CDE and jurisdiction-specific fields. Where regulators have adopted the CDE in a consistent manner, the data across regimes will be harmonized. We firmly believe that this mutualized approach to developing reporting code will improve the accuracy and consistency of reported data by eliminating interpretation risk and will result in a significant resource efficiencies, as each firm will not have to build and maintain their own reporting logic from scratch. Should any changes or additions to the code be necessary due to regulatory clarifications or product evolution, these can be made centrally in the updated code deployed by each firm which has based their implementation on the DRR. Importantly, CDM is open source, and therefore regulators will have transparency into the mutualized code, and we would welcome the CFTC involvement and input. Next, I want to move on to compliance dates. There's another implementation challenge here which is specific to the CFTC, and that's the trifurcation of compliance dates. We recognize that the Commission would like to realize the benefit of the expanded and updated list of reported data as soon as practicable. However, since the UPI and the ISO messaging standard are not yet ready for use, it will be necessary to have distinct compliance dates in the future. Introduction of the UPI will require firms to overhaul their internal approach to product identification, and the work done to extend product identification for the initial compliance date will no longer be of use. Furthermore, the effect of the UPI requirement on other data fields and on SDR validations is unclear, but will seemingly require significant changes to the builds which are used from May 25th, 2022. Likewise, reporting counterparties will produce inbound messages to SDRs in existing formats like FPML, and then will no longer be able to use them once ISO 20022 is mandated. Next slide. ISDA hopes to mitigate some of the additional effort created by this trifurcated compliance timeline through the DRR work, for instance, by extending the CDM code to project messaging in ISO 20022. But the most efficient approach to implementation of the Commission's amended rules would be to have a single compliance date, allowing reporting counterparties, SDRs, and market infrastructures to build once to the final end state and avoid temporary duplicative work. This is the approach expected in the EU and other global jurisdictions. One other item which I'd like to mention is the Commission's ongoing work on the public dissemination of block trades. In the amended version of Part 43, the Commission retained the previously established dissemination delays and adjusted the minimum block sizes and notional cap sizes using an approach which may significantly increase those sizes, making fewer swaps eligible for block trading. The application of these changes is deferred until May of 2023 to allow the industry additional time to adapt and for the Commission to receive the enhanced Part 45 data from which it can recalibrate the appropriate minimum block sizes. We encourage the Commission to study the use of the arbitrary 67% block threshold and 75% cap threshold methodology and consider the potential impact of an increased shift in block and cap thresholds on trading. Before wrapping up comments on swap data reporting, I'm going to pass to Colin to touch on the cross-border reporting release.
Sure, thanks, Tara, and I also want to add my thanks to Acting Chair Benham, Commissioner Stump, and the rest of the GMAC for inviting us to participate on today's session. So, as Tara mentioned, I want to address a cross-border implication of the reporting rules. Since the reporting framework went live and the beginning of 2013, there's either been an exemption or, throughout most of this period, no action relief, which excuses from the Part 45 and 46 reporting requirements a non-U.S. swap dealer that is organized in one of several enumerated jurisdictions that doesn't have a U.S. parent company from reporting its swaps with a non-U.S. person that's not a guaranteed or conduit affiliate. The basis for this relief is twofold. One is that the Commission has not yet been in a position to adopt comparability determinations for the enumerated foreign jurisdictions because a precondition to such a determination is an ability to obtain direct access to data from the local trade repository, and that necessitates, in most instances, a data sharing arrangement with the local regulatory authority. Secondly, of course, these transactions are ones which have a relatively weak U.S. nexus. They are transactions between a swap dealer, as I mentioned, that does not have a U.S. parent company and is organized in a non-U.S. jurisdiction, and a counterparty that's not a U.S. person or a guarantee or conduit affiliate. This relief was most recently extended last November in No Action Letter 20-37. That relief is due to expire December 1st of next year, December 1st, 2022. The purpose of relief was essentially to provide some additional time for the arrangements to be put in place to share data such that the Commission could move forward on comparability determinations. That said, given that those arrangements have not been put in place in the last 8 to 9 years, one might reasonably question whether this remaining, roughly 12 to 14 months is going to be a sufficient period for those arrangements to be put in place. Meanwhile, the ability for non-U.S. swap dealers relying on relief to be able to report their transactions with affected non-U.S. counterparties continues to be impeded by the need to get consent from those counterparties in order to surmount various non-U.S. privacy laws, as well as in many instances very significant technological and operational changes in order to address infrastructure, particularly those in distant foreign branches, which are not set up to report the affected transactions to a U.S. swap data repository. This suggests that it may not be feasible within the next 12 to 14 months for the affected firms, in fact, to build out the capability to report the affected transactions, particularly if they are still waiting on some signal from their local regulators and the Commission that some form of substitute compliance or other relief will not be granted. I would also note that the cross-border application of Part 45 and Part 46 was not addressed in the cross-border rulemaking the Commission undertook during 2020, which focused on Part 23 obligations and therefore continues to be governed by the 2013 cross-border guidance. One possible way to address these matters would be for the Commission to undertake a review of that guidance and whether it continues to be appropriate or whether it might instead be appropriate to codify the no action relief that has been in place for the last 8+ years, or alternatively, whether a further extension might be necessary, possibly as a bridge to such a rulemaking. At bottom, I would suggest, however, that the current situation where we have a no action letter that's due to expire in a little over a year's time, coupled with the long lead time needed for implementation, means that this particular topic is one which needs to be on the Commission's agenda in one form or another in order to avoid some measure of disruption to the marketplace come the December 2022 deadline. Thank you.
Thanks, Colin. And now moving on to uncleared margin. The Phase 5 regulatory IM compliance date of September 1st, 2021 has come and gone without notable impact to the derivatives market. This can certainly be credited in no small part to the actions taken by the Commission and other regulators to first split the final phase of IM implementation into two phases and then defer those phases for a year following the onset of the COVID-19 pandemic. These actions provided valuable time for Phase 5 entities, their asset managers, their dealer counterparts, custodians, and market infrastructure providers to prepare for compliance. Also key to an orderly preparation was the clarification provided by the Commission that documentation and custodial arrangements need not be completed in advance of an obligation to exchange initial margin. This has allowed swap dealers and Phase 5 entities to prioritize relationships based on the anticipated runway to IM exchange and resulted in a two-lane approach, whereby some relationships were designated as a priority for September 1st and others were designated for IM monitoring. An informal survey conducted by ISDA with a subset of dealer and buy-side members suggests that approximately 46% of Phase 6 relationships are currently in the lane for September 1st, while 54% are designated for IM monitoring. Despite concerted effort, not all relationships designated for September 1st were ready by then. ISDA information suggests roughly a 39% completion rate, meaning the relevant credit support documentation and custodial arrangements were in place, and importantly, the parties were operationally ready to exchange IM. Despite that limited completion rate, there was not notable disruption to the market as firms concentrated trading in the relationships that were operational or worked within the boundary of their IM thresholds. Since September 1st, progress has been made on those prioritized relationships, and our latest information suggests a 67% completion rate. The concern regarding this tail is that Phase 6 efforts are delayed as resourcing at dealers and custodians is still focused on Phase 5. This will have a knock-on effect on how many Phase 6 relationships can be ready for September 1st, 2020. Next slide. As the number of Phase 6 relationships is expected to be double that of Phase 5, it's a safe prediction that there will be major backlogs and bottlenecks. The slide displayed are estimates from a 2018 ISDA study. These figures have held up pretty well, though some groups have shifted from the Phase 5 bucket to Phase 6 through increased clearing, counterparty diversification, and portfolio optimization efforts. Phase 6. ISDA is actively discussing the challenges from Phase 5 with buy-side parties, swap dealers, and custodians to understand lessons learned and discover opportunities for improvement. We know that these challenges will be amplified in Phase 6 due to the increased number of counterparties and relationships and the decreased level of experience with regulatory IM, project and legal resourcing, and margin call settlement and dispute management automation. It's important to remain cognizant of the reasons why IM preparation is more challenging for Phase 5 than it was for Phases 1 to 4, and why those challenges will be exacerbated for Phase 6. Both the scale of relationships, as mentioned, and the type of firms and entities plays a role. The nature of these counterparties means there are substantive differences in the requirements for preparation and the approach to compliance. Phase 6 will capture more pension funds, insurance companies, and other end users whose derivatives portfolios are managed by asset managers. Many are newly acquiring an understanding of the regulatory IM requirements and have limited resourcing and technical sophistication to implement the end-to-end process flows, let alone automate them. Phase 6 will capture a greater number of parties located in a wider range of jurisdictions where IM custodial offerings are not widely established, and there may be uncertainty on the enforceability of netting agreements or the ability for the secured party to receive collateral in the event of certain default. I'd like to highlight three areas which pose significant challenge for Phase 6: custodial onboarding, separately managed accounts, and automation. This is by no means an exhaustive list. First, with respect to custodial onboarding, one of the key themes in post-mortem discussions of Phase 5 is custodial onboarding. In prior IM phases, tri-party agents were the norm. Dealers were generally well-equipped to navigate the KYC requirements, and account control agreements were, for the most part, non-negotiable. With a limited number of tri-party agents, the plausible combinations of custodians for pledging and receiving were manageable, and delays in account activation were limited. Most Phase 5 and 6 clients will use third-party custodians designed to serve the needs of smaller parties who may not need the sophisticated collateral valuation, selection, and validation services of a tri-party provider. Contrary to the approach for tri-party custodians, the account control agreements for third-party custodians are heavily negotiated, first for client preferences and then for the preferences of a dealer who will receive the collateral under that arrangement. KYC requirements can also be extensive and vary by custodian. Phase 6 firms will not only need to be KYC'd by the custodian that they have selected for posting collateral, but will need to be KYC'd by the custodian chosen by each of their dealer counterparties from which they will receive collateral. These processes can be very time and resource consuming. Since Phase 1, tri-party agents have improved their onboarding process with online tools, but there are still many jurisdictional and regulatory-specific KYC requirements that both pledging and receiving counterparties are required to meet. As they did for Phase 5, custodians are expected to set individual deadlines for the submission of onboarding documentation in Q1 or Q2 of 2022. Parties which do not submit their completed paperwork on time will have their accounts opened on a best efforts basis. Custodians already supporting regulatory IM requirements are examining their resourcing for Phase 6 and determining whether there are any ways that can make their onboarding processes more efficient. Meanwhile, it's imperative that Phase 6 entities disclose their expected or known Phase 6 status to their dealers, identify their preferred secured party custodian, and begin those KYC processes as soon as possible. Now turning to asset management. A large portion of Phase 6 entities have the derivatives portfolios managed by asset managers. A single entity, such as a pension fund or endowment, might have multiple asset managers to execute different strategies on their behalf. This is referred to as a separately managed account. Because the rules are written to specify legal entity rather than SMA when determining material swaps exposure, IM thresholds, and minimum transfer amounts, this preparation is complicated by the dependency the asset manager has on information and decisions by its clients. Only the underlying client can determine its material swaps exposure. Until notification is made to the asset manager that the client expects to breach the $8 billion threshold, the asset manager cannot begin preparation on its client's behalf. In addition, the asset manager is beholden to its SMA client to determine the division of the IM threshold among its managed accounts. The same is true for MTA, except under the CFTC requirements. With varying degrees of awareness and resources, some clients will not make these disclosures and determinations in time to work with their asset manager to meet September 1st. Turning to automation. Automation, or the lack thereof, on the part of Phase 5 and 6 entities will prove challenging for both regulatory IM and IM compliance. The industry is still vastly dependent on emails, accessing multiple custodian portals, and sending wire transactions with manual intervention. Specific to third-party custodian structures and segregated accounts, secured parties provide authorization to release excess collateral back to the pledger via fax and with manual review of authorized signatures. Although there are efforts to automate margin call communication, collateral allocation, collateral affirmation communication, settlement and release of collateral, there is still much work to do, especially with smaller entities that are on Phase 6. Automation can improve operational, counterparty, and liquidity risk management. However, margin call and settlement volumes will likely have to increase before smaller entities move toward automation instead of increasing human resources with manual processing. I'd be remiss if I didn't highlight some opportunities that Phase 6 entities and their counterparties can leverage to help ease the glide path to September 1st. First and foremost, prospective Phase 6 entities must conduct estimated MSC, or average aggregate notional amount calculations, as soon as possible and disclose their Phase 6 status to their counterparties. They can do this via any method they choose or leverage bilateral or multilateral methods supported by ISDA. Secondly, Phase 6 firms and their dealer counterparties can negotiate their collateral support agreements using ISDA Create, an online negotiation tool which offers output in CDM for internal consumption of negotiated terms and distribution to collateral management vendors. Lastly, I encourage Phase 6 firms and their counterparties to expedite the negotiation of their eligible collateral schedules using one of a number of eligible collateral templates, which ISDA has published. These templates include the intersection of eligible collateral for key jurisdictions. 5 tri-party custodians have created their own versions of these templates for use alongside their custodial account agreements. Finally, I'd like to round up my comments by circling back to the work of this committee and the Commission. On April 27, 2020, the GMAC Subcommittee on Margin Requirements for Non-Cleared Swaps submitted a report to the GMAC with recommendations to improve scoping and implementation of initial margin requirements for non-cleared swaps. On May 19, 2020, the GMAC endorsed the report, voting in favor of adopting the recommendations. The Commission acted on the recommendations in the report by amending the non-cleared margin requirements to first align the method and timing of the material swaps exposure calculation and the post-phase-in compliance state with that of global jurisdictions, and also to codify relief which allowed separately managed accounts to have distinct minimum transfer amounts. These actions on the part of the Commission are greatly appreciated by market participants. There are other recommendations in the report that would provide meaningful assistance for Phase 5 and 6 firms. I would encourage the Commission to consider addressing more of these. For instance, eliminating undue restrictions on the activity of eligible money market funds to transfer assets through SEC lending, SEC borrowing, repurchase agreements, and reverse repo agreements. These restrictions severely limit the availability of money market funds that can be used in the U.S. and make it impossible to use money market funds cross-border with the EU and UK. Secondly, provide an exemption from the consolidation of seeded funds with their sponsors for purposes of calculating ANA and MSC during the limited seeding period to provide a level playing field for these seeded funds. Finally, in accordance with the approach the Commission has adopted on MTAs, allow each separately managed account to be treated as a distinct entity to which a separate regulatory IAM threshold could apply. Before concluding comments on the non-cleared margin implementation, I'd like to pass the microphone to Kyle to touch on portfolio margining.
Thank you, Tara, and thank you also to Acting Chair Benham, Commissioner Stump, Andre Goldsmith, Angie Karna, and the rest of the GMAC members for the invitation to speak with you today. Looking at margin, I'm going to touch on portfolio margining just for a few minutes. I know it's been a while, but back in late 2020, SIFMA and ISDA responded to a joint CFTC-SEC request for comment on potential ways to implement portfolio margining of uncleared swaps and non-cleared security-based swaps. Although staff at both commissions have not yet had the bandwidth to move forward in this area, we hope by highlighting its importance whenever given the opportunity, will find its way back on the front burner soon. As a reminder, once SBSD registration and related rules apply in coming days, non-bank swap dealer, security-based swap dealers, subject to separate and somewhat different margin and segregation regimes, will be at a disadvantage to bank SBSDs, which are able to offer customers the ability to margin a wider range of related products under a consistent regulatory framework. As a consequence, the market as a whole may experience some increase in liquidity, settlement, and operational risks as a result for the non-bank SBSDs to exchange and custody margins separately for swaps and SBS and securities positions. As the Commission both noted in the release, portfolio margining would, by ameliorating these issues, offer substantial benefit to both market participants and the securities and derivatives markets as a whole. These benefits would include greater alignment of margin requirements and the associated costs with the overall risk of a counterparty's portfolio, more efficient collateral management, increased liquidity, and reduced volatility. We also agree with the Commission that any portfolio margining arrangement should take due account of the customer protection, financial stability, and other regulatory objectives that undergird the Commission's respective margin and segregation requirements. In our submission, we suggested a limited number of actions to address the range of trading relationships that will become subject to margin and segregation requirements of both commissions upon the initial implementation of the SEC's rules. We also noted, however, that additional relief may be necessary before initial margin requirements fully phase in on September 1st, 2022. We would welcome the opportunity to take up portfolio margining with both commissions as soon as we're on the other side of settling into the new CFTC capital rules and SEC regime, but in time to address these disparities that will become more prominent once the uncleared rules are fully phased in next September. Thank you.
Thank you, Ms. Cruz, Ms. Brandon, and Mr. Lloyd. The floor is now open for questions and comments on the presentation. As a reminder, if you have any question or comment, please indicate so in the WebEx chat function on the bottom right of your screen, and I will call upon you.
Ms. Carter, I just wanted to check if you wanted to do questions on the reporting and margin first and then our little presentation on capital, or should we do the capital presentation first?
Let's go to capital. I apologize. I wasn't sure if you were finished or not.
Sorry. Then I'll turn it over to Colin Lloyd to kick off the capital presentation. Sorry. Apologies, Colin. I think it might be actually up to me to kick off the capital presentation.
Happy to let you take the floor first, Kyle.
Sure. I'm going to be addressing specifically the some of the cross-border issues of the capital rules, since that's where system members have been most focused in recent days and are still the most open issues. And I'd like to start by thanking the Commission and staff for their engagement on substituted compliance for the capital rules. And while the process wasn't completed for all the applications by the October 6th go-live of the capital rules, we believe that a significant amount of progress was made during a time when there were a lot of other things going on, such as the considerable work needed to address the post-Brexit regime, transition to new reference rates, and the continued implementation of the uncleared margin regime, and all done in a remote work environment. And we are thankful for the no action, the time-limited no action position taken by staff to act as a bridge to the completion of those substituted compliance orders. So there is one forward-looking comment I wanted to make in regard to the orders that we expect to be proposed in the coming year. The CFTC wisely acknowledged that swap dealers are, for the most part, either themselves global entities or part of global groups established all over the world, and did include in their capital rules the option for firms to rely on so-called bank-based approaches, which are generally consistent with the globally accepted Basel capital standards, in addition to an SEC-style net capital approach. This means that both U.S. swap dealers and non-U.S. swap dealers seeking to rely on subcomp may rely on currently utilized bank-style standards and methodologies, which do differ from the net capital approach traditionally applied to broker-dealers and FCM. Looking at U.S. non-bank swap dealers, for those using the net capital approach, the binding constraint on minimum capital requirements will be the so-called risk margin amount, which is based on U.S. concepts. For firms using the bank-based approach, the binding constraint on minimum capital requirements will be a percent of risk-weighted assets, which is based on the Basel-style calculation. These firms, however, using the bank-based approach are still required to calculate the risk margin amount to compare with the RWA. But by virtue of what goes into the respective calculations, the RWA will surely be the larger amount and therefore the binding constraint. For these firms relying on the bank-based approach, calculating the RMA may not be a good use of the scarce resources they have. It does not yield useful information for capital purposes. Turning back to the non-U.S. non-bank swap dealers, we understand that there is still discussion ongoing as to whether the Commission will require an RMA calculation as a condition for non-U.S. firms using bank-based capital standards to be allowed to rely on substituted compliance. It would require significant effort to overlay U.S. calculations over home country calculations, therefore somewhat defeating the benefit of permitting substituted compliance and the comity it implies. Given that most non-U.S. jurisdictions have adopted fully loaded Basel III requirements with various buffers in excess of the 8% RWA calculation required by the CFTC, such an additional condition should be unnecessary. It would be far more consistent with a substituted compliance approach that if the Commission believes the jurisdiction's requirements to be lacking in some specific and identifiable way, then it should base any deemed necessary conditions on the home country's financial reporting and capital regime, rather than adding a condition based on U.S.-style information and calculation. In one other area for non-U.S. swap dealers, I wanted to just make a mention of financial reporting for non-U.S. bank swap dealers. And we sincerely appreciate the active dialogue on making substituted compliance available for non-U.S. bank swap dealers' financial reporting, and appreciate the relief, time-limited relief that was granted to bridge to a more permanent approach. And as the Commission recognizes, bank swap dealers are subject to prudential, not CFTC capital standards. And for U.S. bank swap dealers, the Commission does accept financial reporting that follows the bank regulators' requirements, the so-called call report. Non-U.S. bank swap dealers in G20 jurisdictions and/or subject to Basel capital standards follow their home country capital standards and prepare financial statements according to their home country's accounting principles, and requiring them to submit financial reports in accordance to U.S. GAAP and capital standards would be an unjustified burden, as you recognize and agreed temporarily to permit an English-translated U.S. dollar versions of their home country balance sheet and regulatory capital standards, or for those duly registered with the SEC, focus Part 2C reporting according to the SEC's manner and format order for the covered non-U.S. banks, SBSDs. The relief set out in No Action 2118 set to expire on October 6, 2023, or upon adoption of superseding Commission action to address this issue. And we look forward to such permanent relief being proposed and commenting on it, and will continue to actively engage with the Commission and staff during the process. And with that, thank you, and we look forward to working with you on future action. Colin?
Thanks, Kyle. I just wanted to briefly touch on 3 implementation issues that we have seen in conjunction with the recent October 6th compliance date for the Commission's capital rules for non-bank swap dealers. The first, which Kyle alluded to in the non-U.S. context, is this requirement for a non-bank swap dealer to maintain capital equal to some percentage of its uncleared swap margin amount, which is an amount computed based off of the calculation of initial margin requirements for an uncleared swap, foreign exchange swap, or foreign exchange forward with counterparty, and it extends not only to those trading relationships that are in scope for initial margin requirements, but also other open positions that the swap dealer has. This requirement has presented some significant implementation issues on account of the fact that the various systems and processes that are used to calculate initial margin requirements are only set up in most instances to apply to those relationships that are in scope for initial margin. So, for example, the data which feeds initial margin calculations typically is only data for those relationships, and specifically those credit support annexes that are turned on for regulatory initial margin, such that portfolios which are not subject to those rules do not feed the relevant calculators. In addition, some of the calculation methodologies, particularly in model-based approach to initial margin, may depend on elections that are made on a counterparty-specific basis around such matters as the treatment of securities indices as well as currency conversions. As a consequence of this, it is very difficult for many firms to perform the uncleared swap margin amount calculations, while at the same time, those calculations often are not informing the firm's binding constraint from a capital perspective, as Kyle noted. This was a set of issues which the SEC and their rules addressed recently for a staff FAQ. Their rules likewise provide for a similar calculation called the risk margin amount for security-based swaps. And in light of the difficulties which I just mentioned, the SEC adopted an FAQ position until next September 1st, permitting a firm which is subject to these requirements instead to calculate the initial margin amount using the potential future exposure or maximum potential exposure calculations that it already does for credit risk charge capital purposes. This is something which industry have discussed with CFTC staff, and we hope to get staff's input shortly, but it is a material issue with the rules, which will be particularly significant once the initial financial reports for U.S. non-bank swap dealers are due next month. The second issue, which I wanted to mention, implementation issue, is that, which is a crossover with the SEC, is that a handful of firms which are dual registrants with the Commission and will be registering with the SEC in a few days as security-based swap dealers are electing an approach under the SEC rules called the Alternative Compliance Mechanism, which provides them with relief from various SEC capital and other financial responsibility rules on the condition that they comply with parallel Commission rules and do so with application not only to their Commission-regulated swaps business, but also their security-based swap business. While this framework makes a lot of sense, and as much as it's tailored to address situations where the Commission has a much more significant regulatory interest in the firm and the SEC as a consequence of the firm's limited security-based swap business, a number of questions remain outstanding in terms of how this so-called ACM will be administered in practice. And so we would expect over the coming months that the Commission and SEC staff will need to coordinate in terms of how the affected firms will apply Commission requirements to security-based swaps and how those requirements will be overseen. Third and final point that I wanted to note relates to the ability to use internal models to compute market and credit risk charges for capital, again, for non-bank swap dealers. There are most of the firms which have registered as non-bank swap dealers are either at the legal entity or consolidated group level or at one of their affiliates, subject to another regulator's capital requirements for which they have elected the ability to use internal models. And therefore, they have taken advantage of a provision in the Commission's rules which allow for provisional use of those models subject to an application being submitted to the Commission, or actually, in reality, the NFA, to review those models, and then a review which will take place post-compliance date. On the other hand, there also are a handful of firms which do not have approved models elsewhere in their organization and which had been in discussions with NFA around model approval. These discussions have been difficult at times. There are some no-action letters which are referenced on the Commission's website that address some of these firms, but I think the takeaway is that the model review process is a significant undertaking both for the firm in question as well as NFA staff, and a significant amount of time and resources are necessary to complete that process. And so it does appear that for many of the firms, there was not sufficient time prior to the compliance date for that process to be completed, which has led to, as I mentioned, the need for some relief in some cases. And in addition to that, we do expect that in the coming months, NFA will continue with its process for reviewing the models that firms are using, which have been approved by other regulators. I think in that connection, it will be important for Commission and NFA staff to take due account of the guidance which the affected firms have received from their other regulators in regards to the use of models, particularly where those models are meant to conform to Basel standards as administered by those other regulators, and changes to the model review and model risk management framework at those firms will require consultation coordination with the other affected regulators, and certainly for those firms which don't have model approvals from other regulators, that there will likely to be a continuing dialogue with the Commission so as to ensure that those firms do not face an unlevel playing field vis-a-vis other firms. Thank you. That ends my portion of the presentation.
Thank you, Mr. Lloyd, Ms. Brandon, and Ms. Cruz. The floor is now open for questions and comments on all three of these presentations from our third panel. And as a reminder, again, please use the WebEx chat function if you wish to make any comment or raise any questions. Ms. Kong, I believe you have a comment or question. Please go ahead.
It's just a comment following on Mr. Cruz's summary about the implementation issues impacting U.S. non-bank swap dealers. I think he's made an eloquent description about the three issues, so I won't spend more time elaborating. But it will be really good if the commissioners and the CFTC look into the potential cost and difficulty in time it will need for the non-bank non-bank swap dealers to implement the IAM, the model validation rules. So from a BPAC perspective, we do find that challenging given the current timeline.
Great. Thank you very much, Ms. Kong. Any other comments or questions for our panelists? Ms. Bellick, please go ahead.
Thank you very much, Angie. Just a quick comment related to Ms. Cruz's presentation related to swap data reporting. I think in addition to the cross-border issues and technological and operational issues that Mr. Lloyd also outlined, not only from a cross-border perspective, but in line with current no-action relief. One thing that compounds, I think, the issues surrounding implementation with the CFTC rewrite and other trade reporting requirements that are similarly coming into implementation in 2022 and 2023 is that many jurisdictions outside of the U.S. Look to the CFTC's rulemaking and guidance as a way to engage in rewriting of their own rules and really following suit to what they see the U.S. market doing. And so I think the importance around some of those issues, again, from a coding standpoint, interpretation of very technical and certain, complex, scenarios and decision-making based on certain products, including, things that are currently outlined as, conditional or required or optional based on product type or relationship. I think are becoming increasingly important that, firms have an appropriate amount of time to review those aspects, given that from a home jurisdiction perspective, there will be following of suit in many cases along with that rulemaking. And so, if firms are faced with those issues from a U.S. perspective, they would similarly face similar issues within their home country as well, leading to not only more issues but potentially more fragmentation in terms of how they interpret and tackle those rules. And kind of last point on that is that the data integrity is just as important to firms from a reporting standpoint as it is to the regulators and other market participants that utilize it. And so certainly there's a keen interest, by the foreign banks to have the information that they report under the new rules accurate and complete, not only for the regulators and the market as a whole, but for their own purposes as well.
Thank you very much, Ms. Bellick. Does anyone else have any questions or comments for our panelists?
Hi, this is Dane Twiggs from Cargill. I apologize, I couldn't get the WebEx to work.
Please go ahead, Mr. Twiggs.
Thank you. One thing I'd just like to say about the new capital rule is it's not just non-bank, not foreign entities that are having difficulty with the capital rule. I think internally in the U.S., some of the ideas that were discussed by Mr. Lloyd also are difficult for U.S. participants as well. And so I think it appreciate continued dialogue with the Commission and staff on the rule. So I think it's an important point to remember that for the non-U.S., but also for the U.S. non-bank swap dealers as well. Thank you.
Thank you, Mr. Twiggs. Does anyone else have any questions or comments for our panelists or other GMAC members? All right. Thank you very much to our third panel. I will now turn it over to Andre to finish out the day's agenda.
Thanks, Angie. Thanks to all of the presenters today and to our GMAC members for your engagement in today's presentation. I'm now going to turn it over to commissioners for any closing remarks. Chairman Benham, are you still on? Okay. I think he may have had to drop off a little bit early. In that case, I will move on to Commissioner Stump.
Thanks, Andre, and thanks, Angie, for running the meeting today. And all of the presentations were great. And members of the committee, thanks for your engagement as well. Just a few closing comments based upon what I heard. I want to start with the Treasury market discussion. We've wanted to have this conversation for some time, but we thought we needed time to conduct the well-informed analysis that we heard today and look retrospectively, and also to set the record straight as to who was actively selling and who was active as a liquidity provider and who was not and why. And I think, we as a commission and we as an industry and as a market and the market infrastructure providers, we all know we don't operate in a 2020 or 2021 vacuum, and we cannot ignore the impact of the necessary post-crisis reforms on the traditional liquidity providers. I think it was well established and very tactfully put that the dealers' balance sheets are more constrained and with the new regulatory capital requirements, and yet the Treasury market continues to grow. And so we have to think about things in that context. And I recognize that some of the potential paths forward involve other oversight bodies well beyond the CFTC, but the implications to our markets, the derivatives markets, make it necessary for us to engage. And I think today's presentations, coupled with the benefit of the input from the advisory committee, better enable us to do that. So, again, I recognize this was of interest to everyone, but at the same time, well beyond and more expansive than the CFTC's mandate, but I think it's such an important thing for us to continue to focus on. So thanks to everyone for engaging. And then I also, turning to the second panel, our work is never done. It doesn't matter how long it's been since the event of the financial crisis or the implementation of our Dodd-Frank rules. We always have to be willing to dynamically look at things and consider them in the current context. And I'm not going to talk about all of the various rules that we are covering here and the various things that continue to perplex those who are tasked with implementing them. But I think that, I will say a word, just a quick word about it's been over a year since we reworked our swap data rules. And it was, frankly, a labor of love for so many people at this agency. And as I pointed out then, September 2020, it was important then and it continues to be important that immediate attention be given to substituted compliance determinations for swap data reporting. The various folks who are engaged in that, I think we heard very loudly and very appropriately today that remains critical, and as a year has passed, other things have come into consideration. There is relief that's outstanding. There are cross-border guidance. There's cross-border guidance that is applicable here, and we need to give a holistic view, a holistic consideration to what's next with regard to making swap data reporting workable. Over 50% of our swap dealers are non-U.S. persons. So it stands to reason that we have to give this very thoughtful consideration. I think it's well established that I have publicly
express my concern with the process that surrounded the development of the block trade threshold rules, and I continue to believe we would benefit from publishing the calculated block sizes with the new categories and having a roundtable or a hearing. And while that was a commitment I received from the former chairman, I still believe it would be worthwhile. So I think that with regard to swap dealer capital, we are aware, and I wanted this group to know, we hear you, that there are things that will continue to require our attention to making that rule workable. And I want to commend the division of the Market Participant Division for their efforts in the past few months to really focus on substituted compliance. But I think we've all had many conversations, and we recognize that there's more work to do, and we look forward to doing that. So I could go on. There's so many things. We are not lacking for initiatives and opportunities to improve upon what we've already done. You all know how I feel about the uncleared margin rules. I'm very thankful to this committee and to the subcommittee that worked so hard to come up with things that would make this rule, the event of uncleared margin, more workable. And I think that's where we all have to focus now. Like, what makes sense in the current context? We don't live in 2008, 2009, 2010, or even 2015 anymore. So we live in 2021, and we have to think about what makes sense. So with that, just one more thanks to Andre for her efforts and her ability to take what is normally a very big picture idea that I have relative to the agendas for these advisory committees and making them all come together in a remarkable way. So thanks, Andre, and we wish you well in your next chapter, and we look forward to having a new DFO sometime soon and further engagement with the GMAC. Thanks to everyone for participating.